Very good. A very warm good morning to one and all. Apologies for starting this late by 25-30 minutes because there are a couple of programs going on. And so to start with, may I request our chairman sir, vice chairman sir, regional council colleagues along with today's learned speakers to come forward for the lightning of act.
शुभं कुरुत्वं कल्याणम् आरोग्यं धनसम्पदः शुभं कुरुत्वं कल्याणम् आरोग्यं धनसम्पदः शत्रुबुद्धिविनाशाय दीपज्योतिर्नमोऽस्तु ते दीपज्योतिर्नमोऽस्तु ते शुभं कुरुत्वं कल्याणम् आरोग्यं धनसम्पदः दीपज्योतिर्परब्रह्म दीपज्योतिर्जनार्दनः दीपज्योतिर्परब्रह्म दीपज्योतिर्जनार्दनः दीपो हरतु मे पापम् सन्ध्यादीपनमोऽस्तु ते शुभं कुरुत्वं कल्याणम् आरोग्यं धनसम्पदः शुभं कुरुत्वं कल्याणम्
Request everyone to rise for our IPI motion, please.
यशस्सुप्तेषु जागृति यशस्सुप्तेषु जागृति कामं 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 कामर्षो निर्विमानः निर्विमानः भवेद शुभ्रं भवेद शुभ्रदमं प्रदमं तस्मिन् लोकः अस्मिन् लोषः सर्वे बहूना सर्वे कश्चनान्यपि कश्चन एतद्वैता 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 एतद्वैता
Under the leadership of K. Bhaiya sir and all office bearers and regional council colleagues, office bearers beginning with our chairman sir, vice chairman sir, CFU stand up sir, secretary to CFU Saga, fellow treasurer in absentia, all regional council colleagues, Mangesh Bhai, Sanjay Bhai, and every one of us are collectively working for the benefit of our members and our profession. More than 60-70,000 of CPRs training has been implanted in this 7 months. And we are having regional conference on 19th and 20th of December, requesting all of you to join there. And we are having student national conference on 5th and 6th of December, requesting your articles to encourage to join there as well. So apart from that, there are various initiatives that have been taken over. The various programs have been organized, the details of which are there on WIRC website. All the sessions are there on YouTube channel of WIRC website, and of course, with the permission of the speaker, the presentations have been uploaded on the website. So requesting you to go through it. With this, may I request our Vice Chairman, CFU stand up. come forward and address us.
Participants, hope the breakfast was good. Good morning. Good morning. Yes, thank you for the energy. Uh, Respected listening of the time, speaker for the first session and the speakers as well. Chairman C. Ketan Sayaji, Regional Council colleagues, Secretary C. A. General Madam, then Sanjay Gambhir and Mangesh Ganekarji, and all the participants. Basically, as a team WRC of 21 regional council members, every year you find new chairman, new vice chairman, new team. But one thing in common is request to do something good for the fraternity, for the members and students at large. And this is how we are trying to come up with new programs, new initiatives of the WRC. This year, I just want to update you with one of the important initiative which we think is going to go in a long way. And that initiative is under the committee of CSR committee of WIRC, and it is named as Seva Sarthi. The initiative in short is we are trying to get applications from the eligible NGOs which are working good ethically in the area wherever they are working in the on the purpose area, whatever they are working. But the only one important thing we are looking for, that they should be genuine and they should be compliant. Once we give these applications to the chartered accountant with the help of chartered accountants working with them, we are going to go to the band of soldiers, another chartered accountants who are experts in the field of CSR to verify those particular applications. And once those applications are screened by them, then we are going to help them to prepare the project report for the application of CSR funds. And next, we are going to give the list of such eligible NGOs to the corporate world at large. Again, through the chartered accountants who are working at the helm of affairs there, like someone will be CFO, someone will be like having some acquaintance with the people over there. So the activity in short is like getting the applications, scrutinizing, and then presenting those to the corporate world at large. And at all the three fronts, we request all the chartered accountants to like active part to help employers in achieving some of the initiative good targets over there. The idea behind this particular initiative is we as a chartered accountant are working definitely for a higher strata of the society who are working, who are like earning good. They are going to pay taxes to us. We are helping them to build new businesses and everything. But the lower strata, which don't know about this particular profession, everyone knows about doctors and engineers, but they don't always know chartered accountants. Now, well, if this initiative goes well, they will come to know that chartered accountants are helping them through various companies to get these activities done in a good manner. And I think this is one of the generous activity, one of the good activity to earn self-respect as well as some consciousness. And if this activity goes well, this will be the brand building of ICI and brand building of profession as well. Now coming towards the seminar today, the seminar on transfer pricing, the only key principle which I believe and which I understand here is arm's length price. And here comes again the part of ethics, which on which basis our profession is standing. And some lines for this particular part of our profession is like whenever I find the opportunity about speaking on those things, I like those lines that सफर में मुश्किलें आए तो हिम्मत और बढ़ती है, सफर में मुश्किलें आए तो हिम्मत और बढ़ती है, कोई अगर रास्ता रोके तो जुर्रत और बढ़ती है, बिकने पर आ जाओ तो घट जाता है दाम अक्सर, you lose your value. But ना बिकने पर आ जाओ तो कीमत और बढ़ती है. And that is how we should hold our ethics high whenever we go for any of the activities, professional activities or any of the endeavors in our life as a chartered accountant. With this, I thank for the opportunity and thank you for the patient listening. And be in touch for whatever activities you want with all of us. We are always there. Thank you.
Thank you, Vice. With this, may I request Chairman Sir K.P. Sethia, sir, to come forward and give us opening remarks.
Thank you, gentlemen. Again, of sincere apologies for the delay. A startup conclave going on. One more, I can see Parsala which is a program of members in practice. And a couple of more programs for them. We thought the half an hour difference which was kept between that program and this program will suffice. But the speaker of the setup session got delayed, and that's how we were trying to manage the time, but unavoidable delay. So with this, welcoming all of you to this unsurprising 4 day session, and let me thank Nino for fantastic curation of the program, Saurabh for giving his suggestion, and being kind for becoming the first speaker. And let me tell you that both these gentlemen have their themselves not only practice and they are always available for WIRC to support any of the initiative. So I request all of you to carry a big round of applause for Veeran and Saurabh for giving their valuable time to the WIRC. International Tax Committee is headed by none other than Mangesh Dhanekar. Of course, Mangesh Bhai was the first person who said, let's have a program on transfer pricing. And I told Mangesh Bhai that something is being curated. And by that time, and Saurabh, both of them, I was talking. So Mangesh Bhai said, let's go ahead. Whatever is being planned by both these gentlemen, we'll go ahead with this. So Mangesh Bhai, thank you for that giving us that liberty. We did attempted having one RRC, of course, because of this rate increase and all those things on international tax. Again, a fantastic program was designed, which got postponed. But in the coming months, we will redesign and propose that RRC at COE. Sometimes it was COE Jaipur, but it be COE Jaipur or COE Hyderabad. The since you all are either practicing or intend to practice into the transfer pricing, I think this RRC on international tax will be of interest to you and you must participate. This is the first time ever WIRC is attempting a program in COA, Center of Excellence of ICA, and it is worth seeing both the property, be it COA Jaipur, be it COA Hyderabad. uh, I recognize the presence of Jitendra Sagnani, our Vikasa chairman from Nasik. Jitendra, again, thank you so much for being there always on the weekend. And as rightly told by the gentleman, on 5th and 6th, we are having a national conference for the student at Yogi Sabhagra, and where we are expecting more than 2,500 students, and a similar regional conference also they mentioned happening at Geo World Convention Center. Today, 15th is the last date for the early bird fees. I request all of you to take advantage of these early bird. WIRC's this first year's tenure, we have completed 263 days. Today is this 264th day. And let me tell you, in this 264 days, over 200 programs are organized on a different topic by the all 21 regional council members. We have already come up with 6, 7 publications. We have, worked extensively on the publication. First time ever, the CBS publication, which is, appreciated by many of the managing director of bank, that fantastic publication on core banking solution. We have two e-publication have come, one on Caro. Any listed few listed companies we have compiled. So if you are making a Caro and you want to refer online free publication, just go to the WRC website, log in, and you can download. Even tax audit Excel tool has been designed where references of each clause in the guidance note, new guidance note has been given, and a to-do has been given against each clause. So if you download this Excel and give it to any junior and ask them to fill up, you will easily able to review the tax audit. We are on the point of coming up with the 6th publication on GST. Fantastic publication on AI has come up. We have reprinted. We printed 2,000 copies and got sold. Those copies got exhausted in less than a week. And another 4,000 reprint copies have been just come the last few days before. It is available for sale at down ground. So please buy a fantastic, even if you have not completed a certificate course, you can go to any of the chapters where these tools are described with the pictorials so that you go to website and how will you step by step if you want to use that tool, how will you able to use that. We already had some 35, 36 batches of AI, but moment we announced the batches full, we are having some more batch in the month of November, December, January, and soon all of them will be announced. Okay. A newer area where we should learn have that skill set. So that wherever, whichever area we are practicing, we are able to use the technology. I think there's a lot about WIRC, but since you have been it, and cutting on my talk, and with this, once again, welcome all of you to this fantastic whole day program on transfer pricing. And congratulations to the International Tax Committee Chairman Mangesh Ganikar for a beautiful program being today. Beautiful.
Thank you, Kavita. I had already said by Chairman Sir, there are a number of programs, publications, seminars, virtual programs going on. So let us, collectively work for our beloved profession. With this, may I request Regional Council colleague to come forward and introduce our today's learning speaker, CS Saurabh. May I request Sanjay Bhai to come forward? We're going to talk on basics of transfer pricing history, method of valuation, CS Saurabh.
Good morning, friends. This is right for me, honor for me to present before you and introduce today's faculty. Friends, it is very satisfying and moment that such kind of attendance is there in short span of period. We can see young faces here who are very keen in transfer pricing. And pointing out this fact, our chairman has come out with the idea that this year, first time in history, we have separated transfer pricing and international taxation, and we have created a separate committee for that. And it is headed by Mangesh Dhanikar, sir. And under his leadership and guidance from the chairman, we have created this program. Friends, I'll introduce today's faculty for sharing his wisdom and knowledge is with us. The topic is basis of transfer pricing history, method of valuation, and we have with us Saurabh Bhat, a very renowned personality in the field of transfer pricing. Saurabh is a practicing chartered accountant who specialize in tax litigation, advice and advisory, bringing both depth and clarity to the subject. With an LLB from Government Law College, Mumbai, he blends legal insight with technical tax expertise. His academics record reflect his commitment to excellence, and I would like to have a big round of applause for his academic achievements. He is a rank holder throughout all levels of CFOs, including all India rank 31, and secured the seventh rank in Mumbai University during his BCom. So, such a wonderful personality and knowledgeable personality with us. And I'll request our WIB chairman, vice chairman, secretary, and and Vikasa chairman Jitin Bhai, Mr. Mangesh Dhanikar sir, to come forward to felicitate our today's respected faculty. Over to you, sir. Take the
In fact, Saurabh was speaker in last year in our student conference, the student program, 1 or 1.5 year back, and he was teacher for years on this subject in JK Shah class. So I think I got a reference from my son, if I recollect correctly. My son was while doing CA, he was attending sir's lecture, and he said, "एक बार sir को बुलाओ." And he usually never used to come to WIRC, and I requested him to come, and a lot of appreciation from student also in those days for that international tax program. So thank you so much, Saurabh. Sir.
Good morning, everyone. Respected Chairman WRC, Shri Ketan Senya sir, respected Vice Chairman, Piyush Tandal sir, Head of International Tax and FEMA Committee, Shri Mahesh Ganikar ji, Mangesh Ganikar ji, other regional council members present on the dais, dear professional colleagues, my co-speaker for the day, and other members of the audience. A very good morning to all of you. I hope I am audible even at the last benches. Yeah. Okay. At the outset, I thank WRC for providing me with this opportunity to speak at today's session. Today's session is on transfer pricing, and as we all know, that India is one of the fastest growing economies of the world, and because India is the fastest growing economy of the world, with liberalization and globalization which we have witnessed over last several years, there are many multinationals who are setting up their subsidiaries or offices in India. At the same time, there are many Indian multinationals which are setting up subsidiaries or offices outside India. Naturally, in such cases, there is an opportunity for profit shifting. The reason being that when we do a transaction with a related party, the intention of conducting that transaction can be other than commercial considerations. If, for example, I ask each and every one of you that you have a huge tax liability during the year, you have two options. Either give me a professional fees of 1 crore rupees and reduce your tax liability, or you give it to a family member of yours and reduce your tax liability. I'm sure you will select the second option. If there is anyone who selects the first option, please do contact me. The point is, when we do a transaction with related party, our intention of doing the transaction can also be other than the commercial considerations to that transaction. One of the consideration can also be to shift profits. As we are all aware that different countries have got their different tax norms. So naturally, a rational person will try to shift profits from a high tax jurisdiction to a low tax jurisdiction. Unless you are monomaniac and you want to shift your profits to a high tax jurisdiction. So in such a way, corporates and multinationals may be able to shift their profits and reduce their overall tax liability. This is a type of tax avoidance, and naturally, whenever there is any tax avoidance, you require anti avoidance rules. One of the anti avoidance rules, there are various anti avoidance rules, specific anti avoidance rules. One of them is transfer pricing. Transfer pricing is incorporated in Chapter 10 of the Income Tax Act 1961, and transfer pricing was introduced in India in the year 2001. Over the years, as you can see on your screen, there have been several amendments made because in the last 2 decades, the importance of transfer pricing has increased manifold. As I told you that now India is the third largest economy of the world. So as a result, there are several multinationals who are setting up offices in India and they may try to shift their profits to their parent entity. Because everyone loves to do business, but nobody loves to pay tax, isn't it? So over a period of last 10 years, you can see the number of amendments that have come in the Income Tax Act, and these are basically to align our laws with international practices, best international practices. And thereafter, we have seen the Act as it stands today. We will also be looking at certain corresponding amendments which are in the new law. As you know, that in 2025, we are going to have a new Income Tax Act. There is a new Income Tax Act which comes into force from the next year. First of all, I hope everyone is okay with English or you like Hindi plus English. It's your choice. Everyone comfortable? Yeah. Last benchers. Oh. Now, as far as applicability of Section 92 is concerned, when is transfer pricing chapter applicable in your case? First and foremost, you are required to satisfy two conditions. First, there has to be an associated enterprise. Associate enterprise, when is it the relationship of associate enterprise is created? We'll be looking at it in maybe next 5 minutes. But you can say associate enterprise is synonymous with related party. Just as a common logic, we can say it is like a related party. And there has to be an international transaction with the associate enterprise. International transaction means that at least one of the parties has to be a non-resident. You may say at least one party. मतलब दोनों पार्टी अगर नॉन रेसिडेंट रहा, even then can transfer pricing provisions apply? Indian transfer pricing provisions? And the answer is yes. under section 9, there are certain situations when transactions between two related parties, both of which are non-resident, or transaction between two non-residents also can be brought within the purview of Indian tax law. And if both those non-residents happen to be associated enterprise, then in that case, even the provisions of transfer pricing shall be attracted. So coming back to the point, first and foremost, the transaction should be between two or more associated enterprises, and at least one of the associate enterprise should be a non-resident. Also, the transaction must be affecting at least my income, expenditure, asset, or liability. Only in such scenario would I say that the provisions of chapter 10 are attracted. Also, please remember, there may be certain understandings or arrangements which are oral in nature. Even oral understandings are covered within the purview of the term transaction, and even those will be covered within the purview of transfer pricing. We will be having a slide on AMP expenses. At that time, we will look at those oral understandings. However, government is quite smart. Government says if on application of transfer pricing provisions, there is a reduction in my total income, then you will not make adjustment. Yani transfer pricing can be used only for upward adjustment to my income. Upward adjustment to my income can happen in two scenarios. Either my income is understated or my expenses are overstated. In either those scenarios, the provisions of transfer pricing will arise. If there is a situation wherein I have already earned above the arm's length price, my margins are above the arm's length rate or arm's length range, then there is no requirement of making any transfer pricing adjustment. I hope this point is clear. Also, I would request at any point of time, we can pass the mic if you have any queries. I'd be more than happy to address those queries. Plus, I'll come to know that you all are paying attention and not sleeping. Okay. Now, as far as non-applicability, there have been certain judicial precedents which have held, wherein it has been held by courts that transfer pricing provisions are not applicable. The first one I would like to explain because it's a very interesting case, and that case is of Vodafone India Services. Now, what happened in Vodafone was the assessee issued certain shares to its associate enterprise outside India. Let us say 10 रुपए का शेयर था, I issued it at 12 rupees per share. The transfer pricing officer said that you should have issued the shares at a much higher value. So you should have issued the shares at say 50 rupees or 60 rupees or 100 rupees. So you have earned less, you have brought less funds into India. And therefore the difference I want to add to your total income. The assessee responded that, sir, let us assume I have not issued shares at lower than fair market value, but let us assume for argument's sake. Even if I had issued the shares at a higher value, that would have gone into my securities premium. So where is the question of any income escaping assessment? The TPO said that no, sir, if you had issued the shares at a higher value, then you would have brought more funds in India, which you maybe could have kept in a FD and earned interest on that. The assessee, when he received the order, he did not go to DRP or CITA. He directly approached Bombay High Court by way of a writ. He said that here my transaction of issuance of shares is not going to affect my income at all, even if I issued shares at a lower value. The assessee also argued that if you look at provisions of section 56, if you are aware, up till last year, now they deleted the provision. There was a provision of 56 subsection 2 clause 7b, which said that if you issue shares at higher than fair market value, then the excess can be added to your income. I hope you are aware of that provision. So there is no charging provision where I issue shares at lower than fair market value. Bombay High Court accepted this stand, and in the case of Vodafone India Services Private Limited versus Union of India, Bombay High Court held the TPO's action to be null and void, and they said this transaction of issuance of shares cannot be brought within the purview of India transfer pricing regulations. As practitioners, if any one of you all files Form 3CEB, I hope you know the report under Section 92E is called as 3CEB. And there is a transaction wherein the assessee has issued shares to the associate enterprise. What I advise is do report the transaction, and you can write a note saying that this transaction, although does not come within the purview of Chapter 10, however, out of abundant caution, we are reporting this. Because end of the day, it is a transaction with associate enterprise, there is no denial of that. However, that transaction cannot be brought within the purview of Chapter 10 as held by Vodafone's case. In fact, if you closely observe the year of that case, it is 2014. I'm sure you all are aware 2014 was the year when Mr. Modi came to power. So after this decision came, the finance ministry came out with a circular wherein they accepted the decision. Otherwise, prior to 2014, we saw that every decision of High Court, which is in favor of assessee, the revenue would invariably file a SLP with the Supreme Court. But this decision was accepted by the government. The instruction number is also mentioned at the bottom. Instruction number 2 of 2015, wherein Revenue Finance Ministry said we will not be filing a special leave petition. The last topic for the day, the last speaker for the day is going to speak about the recent case laws in transfer pricing. Very recently, if I may mention, in the case of Vodafone again, the government has withdrawn a pending litigation from Supreme Court, which involved the transfer of their call center operations. And the TPO had applied its logic. Both the parties to the transaction were residents. Both the parties were residents. So Chapter 10 is clearly not applicable. But the TPO applied a logic that you have transferred certain embedded intangible assets, which gives rise to an international transaction. So government has just last month withdrawn that appeal pending in the Supreme Court. I hope Vodafone's case law was clear. Similarly, friends, in case of CIT versus PMP auto components, Supreme Court of India has held that where there is a transaction involving purchase of shares from non-resident associate enterprise, if you are purchasing certain shares from your associate enterprise, that also transaction cannot be brought within the purview of transfer pricing regulations. So far, I hope everyone is following. Any doubts up till now? Yes, sir.
So there is one very tricky point. What happens if it is the first time investment?
Yeah. That time it's not your associate enterprise at all.
So do we file from this?
Absolutely not. Because that's not your associate enterprise at all.
Once I cross my 26% shareholding, then subsequently am I to report the?
Absolutely. You will have to, because then it's your associate enterprise. Okay. CIT versus Bosch and Lomb, I'll be covering a bit later because this is on AMP expenses. So after the methods, we have covered a slide on AMP expenses. At that time, we'll be talking in depth about Bosch and Lomb. Okay. Coming to the first condition. So I hope everyone is clear that there are two conditions, cumulative conditions required for attracting this chapter. One, that there should be two associate enterprises, and second, that there must be a international transaction between the associate enterprise. So first and foremost, what is the definition of associate enterprise? So section 92A of the current law comprises the definition of associate enterprise. This section is divided in two subsections, 92A subsection 1 and 92A subsection 2. 92A subsection 1 provides a generic kind of condition, whereas subsection 2 provides the test, the actual conditions. So if you look at subsection 1, it says, for the purpose of this section and other sections of this chapter, associate enterprise in relation to another enterprise means an enterprise which participates directly or indirectly or through one or more intermediaries in the management or control or capital of the other enterprise, or in respect of which one or more persons who participate directly or indirectly or through one or more intermediaries in its management, control or capital are the same persons who participate directly or indirectly in the management, control, capital of the other enterprise. यानी अगर दो entities हैं and you are able to demonstrate that one entity has the control of the other enterprise or has participation in the capital of the other enterprise or is managing the other enterprise, then I would say that those two entities are regarded as associated enterprise. I hope subsection 1 is clear. It provides a generic test. But now if you look at subsection 2, it says for the purposes of subsection 1, there has been litigation on this phrase as well. For the purposes of subsection 1, two enterprises shall be deemed to be associated enterprises if at any time during the previous year, first condition is one enterprise holds directly or indirectly shares carrying not less than 26% of voting power in the other enterprise. So if I may ask you, so that you can also think about it. Suppose I am holding 26% preference shares of another enterprise. Would it satisfy this condition? Yes or no? No, why? Power, because preference shares do not give me voting power. I need to have 26% shares. I can hold directly or indirectly. It's not necessary that I have to hold directly. If you can see the diagram, entity A is directly holding 33% shares in B. However, it is also holding 26% or more shares indirectly in C. So A and B become associate enterprise. A and C also become associate enterprise. I hope this is fine. Second condition, any person or enterprise holds directly or indirectly. Please carefully observe the phrase directly or indirectly. Shares carrying not less than 26% of voting power in each of such enterprises. I hope the diagram is self-explanatory. That in X and Y, there is a common entity, that is Mr. A, who is holding at least 26% shares carrying voting power. So can I say Mr. A and X Limited become associated by virtue of clause A? Mr. A and Y again become associated by virtue of clause A, but X and Y become associated by virtue of clause B, because in each of them there is a common entity holding at least 26% shares. Clear? Third is a loan advance by one enterprise to the other enterprise constitutes not less than 51% of the total book value of assets of the other enterprise. Can anyone tell me, I have given a loan to another entity? Why is it that I am regarded as associated with that entity? Can anyone tell me? Please understand one thing. The conditions given over here have to be seen from the perspective that I am able to influence the pricing decision of that person. I am able to influence how much price I will charge him or how much price he is going to charge me. If I have given loan to him which constitutes at least 51% of book value of his assets, then don't you think that he will have a sense of gratitude towards me? If I always give this example, let us say there is a new chartered accountant who wants to set up his practice. He comes to me and says, "Sir, मेरे को 20 लाख रुपए की जरूरत है because I want to take a office on rent, do the furnishing, etc. I want to buy a laptop." Now I give him 20 lakhs or I give him 15 lakhs. Don't you think later if I go to him saying that मेरा ITR file करो, he will charge me as per market rates or below that? Naturally below that. So when a person is indebted to you, metaphorically and actually, that person is not going to charge you as per the market prices. That's the idea behind this. Also, let me clarify on this. ऐसा जरूरी नहीं है that merely because associate enterprise है आपने arm's length price charge नहीं किया होगा, ऐसा जरूरी नहीं है, but it gives a rise to a suspicion. So department says we want to ensure, we want to assure, we want to check that the transaction is at arm's length basis. I hope condition C is clear. Sir.
So we should test this every year because it might go below that 51%.
Every year, definitely every year. In fact, I will be taking one case law. If you see subsection 2, subsection 2 क्या कहता है? At any time during the year, not just as on 31st March, at any time during the year you satisfy for the entire year, you are regarded as associate enterprise. एक बॉम्बे ट्राइब्यूनल का डिसीजन है where the assessee entered into a transaction with another person on 8th of August. They happen to become associated in the month of November. नवंबर में कोई तो क्राइटेरिया सेटिस्फाई हो गया, शेयर्स ले लिया या लोन दे दिया, whatever. The assessee said that this transaction was conducted before we became associated. So TP provisions are not applicable. I hope you understand. Bombay Tribunal ruled against him. Tribunal said that if at any time during the year you satisfy the condition, the provisions of transfer pricing will apply for the entire year. Are you understanding? Any other queries? Next is one enterprise guarantees not less than 10% of total borrowings of the other enterprise. You can derive your logic from there. If you are major guarantor to another enterprise, naturally you will be able to influence the pricing decision of that other enterprise. More than half the board of directors or members of the governing board or one or more executive directors or executive members of the governing board are appointed by the other enterprise. So in one entity, if there are, let's say, 7 directors, I appoint 4. So more than half ho gaya. So I will be regarded as a associate enterprise for that particular entity. Or in two entities, one common enterprise is appointing more than half of board of directors or one or more executive members. Clause number G, I request your inputs in which situation it gets attracted. The manufacturing or processing of goods or articles or business carried on by one enterprise is wholly dependent, entirely dependent, wholly dependent on the use of know-how, patents, copyrights, trademarks, licenses, franchisees, or any other business or commercial rights of similar nature, or any data or documentation, drawing specification relating to any patent, invention, model, design, secret formula, or process of which the other enterprise is the owner or has exclusive rights. Can you tell me which type of entity, which type of arrangement are they talking about?
Licensing.
Very good. Licensing or franchising. Can I say in case of franchisee or licensing, your entire business is dependent upon the intellectual property of the other enterprise? So in such case, there may be a situation where clause G is attracted. If any one of you all has dealt with liquor industry में there is something called as bottling units. So if there is a enterprise located in Maharashtra, as per the state excise law, आप किसी स्टेट में जाके सिर्फ अल्कोहल बेच नहीं सकते. Alcohol is regarded as a negative product in India. So state government says, if you want to sell alcohol in my jurisdiction, you first set up a factory in my jurisdiction. So जो फैक्ट्री में सेटअप करूंगा या फिर जिस मैन्युफैक्चरर के साथ टाई अप करूंगा, when he sells alcohol, he will sell it under my brand name. He cannot apply any other brand name. I'm sure I'm audible. Yeah. So shall I continue? It's fine. Yeah. So when I sell alcohol in that state, he will sell under my brand name. His job is only to bottle the alcohol. So can I say that entire unit is dependent on the secret formula which I provide. I send him a concentrate of that liquor or alcohol and they merely do the bottling. So even in that case, clause G can be said to be attracted. Okay? Yes or no? Okay. Next is 90% or more of the raw materials and consumable required for manufacture or processing of goods or articles carried out by one enterprise are supplied by the other enterprise or person specified by the other enterprise. Like for example, if you eat cream biscuit अगर आपके बच्चे बच्चे खाते हैं तो in that cream biscuit they have got orange cream, vanilla cream or pineapple flavor, whatever. That particular raw material generally the manufacturer will obtain only from one person. I had a client where that person had only one customer, Parle. He used to supply orange cream to Parle. Orange cream बनाने के लिए सबसे basic raw material is oranges. And he used to procure it only from one supplier in Brazil. So can I say his 100% raw material is been obtained from that particular enterprise? So that Brazilian entity and my entity would be regarded as associated enterprise. Next is the goods or articles manufactured or processed by one enterprise are sold to the other enterprise or person specified by the other enterprise, and prices and other conditions are influenced by such other enterprise. Can anyone tell me an example of this? Anyone? Captive consumption units. In case of captive consumption units, जैसे पेप्सी है तो पेप्सी का बॉटल इज ऑफ अ डिफरेंट शेप तो दैट बॉटलिंग यूनिट जो रहेगा जो बॉटल बना रहा है कैन दे सेल इट टू कोका कोला they can't. They must be having a tie-up arrangement that you cannot supply this bottle to anyone else except us. So naturally, Pepsi क्या बोलेगा? Pepsi बोलेगा that sir, Mr. Bottling Unit, suppose you are to find customers in the market, तो आपको marketing का खर्चा आता, आपको credit risk रहता that you supplied the bottle and somebody did not pay you on time. Whereas here I am your sole customer. There is no risk of bad debt. There is no risk of marketing cost. You have to perform the functions only for me. So naturally, I can influence your pricing. Bolo yes sir, no sir. Okay, next one. Where one enterprise is controlled by an individual, the other enterprise is controlled by such individual or relative, or jointly by such individual and relative of such individual. So there are two entities controlled by one same person. Last is where one enterprise, the third last, is where one enterprise is controlled by an HUF, the other enterprise is controlled by member of such HUF. You can see the diagram, it's self-explanatory. If you are talking about a firm or an AOP or BOI, in case of company, minimum 26% shareholding is required, shares carrying voting power. But in case of firm, AOP or BOI, you require 10% shareholding. If you are having 10% stakes, rather, if you are entitled to 10% of profits in that entity, then I would say you are associated enterprise. Okay?
So if there are trusts created where the shareholding exists, then
Yeah.
also come under this.
Trust, you are saying charitable trust?
No, in a company sometimes they have that the employee trust which holds the
Yeah. That can also come within the purview, but you also need to remember that there is a second condition also that it has to be an international transaction. Associate enterprise to hai, but in order to attract this transfer pricing chapter, there is a second condition also. Okay. Now, these are the points which I have already discussed. That as far as first and second clause are concerned, the wordings used are directly or indirectly. However, in all other clauses, up till clause M, the relationship has to be direct. Also, the relationship should be attracted or satisfied at any point of time during the year. I give you the example. This was Bengaluru Tribunal, sorry, in Palmer Investment Group, where they said that you have done a transaction on 1st August. However, you become associate on 10th October. Still, the provisions of transfer pricing shall apply for that entire year. Okay, can we proceed?
yes, sir.
Okay. Now, one interesting controversy which has been solved in our 2025 Act. Next year onwards, as I mentioned, there is a 2025 Income Tax Act, new Act. Whether provisions of Section 92A subsection 1 are independent and in addition to the tests provided in 92A subsection 2. At the very beginning, I mentioned that subsection 1 provides vague conditions that you need to have entitlement in the management control or capital. Subsection 2 starts with the phrase for the purposes of subsection 1. So, can there be a situation where I do not satisfy any of the tests of subsection 2, but the TPO, transfer pricing officer, invokes subsection 1 and regards me as an associate enterprise? Can there be? I am asking. Supreme Court said no, you can't do that because this was an issue raised in the case of Veer Gems and this was Gujarat High Court decision. Supreme Court merely dismissed the SLP, so they affirmed whatever was done by the Gujarat High Court. Now, what were the facts of the case? Quickly running through that. The assessee Veer Gems, a partnership firm engaged in the business of diamond manufacturing and export, made certain international transactions with a foreign company named whatever. The TPO treated Veer Gems and the foreign entity as associate enterprise and made transfer pricing adjustment by benchmarking their transaction. The TPO's conclusion of an AE relationship was based on the factual finding that two business entities had business dealing with another common entity, that was Blue Gems USA. यानी वो क्या कह रहे थे सिंपल शब्दों में that Veer Gems had this customer in Netherlands, they had a common customer in US. So the argument was that because of this common customer, you are able to control this entity located in Netherlands. And as you know, subsection 1 uses the word control. The assessee challenged this, stating that the statutory requirement for establishing AE status under 92A were not met. Assessee's contention, बाकी तो सारे चीजें ठीक है. They relied saying that we are not controlling this Netherlands-based entity. However, one of the important arguments was the last point, that relying on plain reading of 92A, the assessee contended that subsection 1 and 2 must be fulfilled cumulatively. यानी वो कह रहे हैं कि subsection 1 में we have given the basic kind of condition that management control capital must be influenced by one enterprise. However, how that influence happens is given in subsection 2. If you don't satisfy subsection 2, then under subsection 1 the relationship cannot be created. Are you understanding this? Supreme Court affirmed the view taken by High Court of Gujarat, and they said that subsection 1 and 2 must be read together, and subsection 1 and 2 are interlinked and must be read in a harmonious manner. The court observed that reading them independently would render one of the subsections otious यानी irrelevant, which is impermissible under the well-established canons of statutory interpretation. So the law as it stands today is that you need to satisfy the conditions of subsection 2, which are more specific in nature. Is this clear? But this understanding is valid only for next 4 or 5 months, because under the 2025 law, government very smartly in the bill income tax bill 2025, if you look at the second bullet point, section 162 subsection 2 of the bill started with the phrase without affecting the generality of the provision of subsection 1. यानी जो पहले लिखा था for the purpose of subsection 1, they have changed that and they made it as without affecting generality of subsection 1. So they tried to create a distinction between subsection 1 and 2, wherein subsection 1 could be read independently. But then when final bill was passed, government said why to have even that litigation? They combined both the sections. So now if you look at section 162, the first condition is nothing but subsection 1 of the old law. अभी हमने सारे conditions देखे 26%, 51% of book value is given as a loan. Now the first condition is where one enterprise influences the management control or capital of the other enterprise. That is now the first condition. So you don't need to look at any subsection 1 and 2 independently. If you say that this amendment is made to overrule Supreme Court decision in Veer James, then I agree with you. However, this treatment in 2025 Act can also give rise to a multiple of litigation. Because now I hope you understand section 162, the first condition is very vague. It says that one enterprise is able to influence directly or indirectly management, control, or capital of the other enterprise, then they are deemed as associate enterprise. So now, transfer pricing officer, even if you say that, sir, none of the specific conditions are satisfied, he may try to invoke the first condition and thereafter say that these are nothing but associated enterprises. I had a case of a listed client. I'll not name them because they are listed. उनके केस में thin capitalization rules were getting attracted. Thin capitalization is where your debt proportion is very high as compared to your earning. Thin capitalization attracts when you are dealing or rather borrowing from an associate enterprise. So they had an associate enterprise in Singapore. Provision of thin capitalization came into effect from 1st April 2018. So just before 1st April, they reduced their shareholding in that Singapore based entity to 25.9% or 25.8%, just so that under the first condition of 26% shares, they were not getting satisfied and therefore there was no need to apply thin cap. With the tax head of that entity, he told me, no, I am relying my rationale on Veer Gems because Veer Gems at that time was Gujarat High Court. So I told him, you are exposed to two risks now. एक तो है 1st April 2018 was also the year when GAR came into picture. So the transfer pricing officer or the assessing officer may say that you are trying to avoid a specific anti-avoidance rule. So let me invoke general anti-avoidance rule. And second is now post amendment of 2025 Act, the TPO may say that this is nothing but your associate enterprise because you are able to influence the management, control, or capital of that other enterprise. I hope the discussion up till now is clear. Shall we proceed or any doubts or clarifications required? Shall we? Yes, sir.
Yes, sir. We providence have to be, so we will have applicable on general year.
Yeah, absolutely.
Okay, so only
Absolutely. It will apply year on year. Every year you have to test it. Every year as chartered accountants, when you are doing the compliance of form 3CB, so you have to test this. You have to check. Otherwise, generally what happens is people look at RPT schedule and RPT schedule may say they identify, but in reality, you are required to take a deeper understanding whether any of the other clauses are getting satisfied. Okay. Now, as far as transaction is concerned, as we saw that apart from there being a associate enterprise, there also needs to be a international transaction between the associate enterprise. So the transaction as defined in section 92F clause 5, it says it includes an arrangement, understanding or action in concert, whether such understanding or arrangement is formal or in writing, or whether or not such arrangement, understanding, or action is intended to be enforceable by legal proceedings. So it can be oral understanding or it can be a written understanding. Naturally, many people ask me that if it is a oral understanding, then how will the officer come to know about this oral understanding? Now, how the officer comes to know or how he makes allegation is his lookout. But I have seen one case where the income tax department was conducting a survey, and during the survey, they happened to look at the CFOs. They clone the laptops these days. They take a clone of your laptop. That is also not legally permissible, but they do that. And they found one WhatsApp communication in the CFO's mobile phone with one of the entities outside India, and based on that they made a allegation not in the context of transfer pricing but in some other context that there was a understanding, oral understanding between the entities. Is that fine? Okay. However, please remember, merely because there is an incidental benefit, that does not constitute a transaction. what is meant by incidental benefit? Can I say that there are many brands in India which are subsidiaries of foreign brands? Can you give me an example? I can give you one. Unilever is a foreign brand. The brand is foreign, but in India you have Hindustan Unilever. Anyone else? Sorry? Bata. Bata. Okay. PNG. Yes. Tesla. Tesla also has set up their showrooms in India. Now, can I make a statement that all these brands would be incurring very heavy costs towards advertisement, marketing, and publicity? They'll incur huge advertisement costs in India in order to promote their products. Now, can I say because of that promotion, the brand is foreign. So there is an incidental benefit arising to that foreign enterprise. Am I right? Merely because there is an incidental benefit, that does not constitute a transaction. There has to be an understanding, there has to be a agreement either orally or in writing. Only then can you say that it constitutes a transaction.
But many of these incidents also pay a royalty for using that logo and the brand name.
That is तो disclosed international transaction. When you pay royalty to your holding company, वो तो आप बता के कर रहे हो ना international transaction. AMP expense में क्या होता है? I am incurring huge advertisement cost to promote my product. The TPO says that ये brand तो foreign है. So because of your promotion, the foreign entity is getting a benefit. So you should have recovered some cost from them on that AMP expenses. Now whether that is permissible or not, it is impermissible. But we'll look at that case law later. But here, the point I'm trying to make is there is no transaction at all. ओके जैसे बहुत पहले एक निम्बस कम्युनिकेशन का केस लॉ आया था wherein I sold goods to my associate enterprise, let us say at 100 rupees. I sold goods to a non-associate enterprise at same value. So the assessee said that the transaction is at arm's length. However, to my associate enterprise, I gave extra credit period. ज़्यादा credit period दिया. As you know that higher the credit period, higher the cost, time value of money. So the TPO said you should have charged separately for this extra credit period. When matter reached tribunal, at that point in time, before amendment by 2012, tribunal said this is not an international transaction at all. The transaction is sale of goods. Recovery is a consequence of the transaction. अब ये अलग बात है that they have specifically included credit receivables or payables as a separate international transaction. You have to separately benchmark. Deemed international transaction, there are very smart people in India. India में मैंने एक देखा है as a litigation advisor, I always tell them, please avoid litigation. Because litigation and disease are two things you don't know when it will end. आप थक जाओगे, government machinery will not stop. I had a client, he took a very aggressive position by claiming depreciation on goodwill created on amalgamation. Some of you all may be aware, 2021, the government has now stopped it, saying that goodwill को हम depreciation देंगे ही नहीं. ये 2013 का transaction. And that too, amalgamation between two related parties. So amalgamation is tax neutral. The transferor does not pay any tax. Under section 47, it's a neutral transfer. But the acquirer depreciation based on the fact that goodwill का उसका जो purchase value है, fair market value. 2016 के बाद तो now India does not allow it for amalgamation between related parties in business combinations. However, this is prior to that. I told him, he said, no, we want to take this aggressive stand. We won in tribunal in 2018. I told him, naturally, he was very upset. Department went to High Court. I said, naturally, they will go. You have done such an aggressive tax planning. Do you think the department is going to accept it at tribunal level? They are not going to do that. If it runs into crores, they will file appeal in High Court. They will even go in Supreme Court. So, when you take a position, you have to be careful about it. Moving ahead, as far as the next point is concerned, is deemed international transaction. I was saying that in India, we love to avoid compliance, we love to avoid taxes. So one of the things which government already visualized is that, let us say there are two associate enterprises. In order to show that this is not a associate enterprise transaction or international transaction, you bring a third party in between, accommodating party. And instead of selling directly, you route the transaction via that third party. I hope you're understanding. There's a diagram also for this. But there is a prior understanding. So in this case, if company B and company A are doing a direct transaction, naturally it constitutes international transaction. So in order to avoid that, एक unrelated entity है पहचान का, उसको बोला कि भाई company A will supply the goods to you and thereafter company C will supply it to company B. So can I say in my balance sheet I am company A, there would not be any international transaction reported because मेरा transaction associate के साथ है नहीं. But then government says we already know people are going to do this, so this is nothing but deemed international transaction. Is that fine? Are you able to follow everyone? Okay. Now, what is included in the definition of international transaction? I would say I'll just cover one important point because I think I have to finish in next 15 minutes. International transaction covers everything under the sun. Any kind of transaction which you do now by way of with your associate enterprise that can give rise to TP compliance, that is transfer pricing compliance. However, one point has to be noted. As far as 92B is concerned, that is definition of international transaction, the main definition says that a transaction would be regarded as international transaction only if it happens to affect my income, expenditure, assets or liabilities. Only then it is regarded as international transaction. Our government, when they lost certain cases, like I gave you the example of credit receivables, they added an explanation, and under the explanation, they added all these clauses. My main focus is on clause 3. Capital financing, including any type of long-term or short-term borrowings, lending or guarantee. Purchase or sale of marketable securities or any type of advance payment or deferred payment or receivable or any other debt arising in the course of business. So capital financing transaction like receivable payable as on the last day of the year or corporate guarantees provided, even those are regarded as international transaction. However, courts have consistently held that this explanation should meet text of main section 92B. 92B requires that the transaction must be affecting my income, expenditure, assets or liabilities. Only then the transactions covered in this explanation will also be regarded as international transaction. Government said no problem, हम उसको भी अमेंड कर देते हैं. As far as 2025 Act is concerned, in that Act they have now given a category wise definition. So they have just given buckets. What is international transaction? Point number 1, so and so. Point number 2, so and so. Point number 3, so and so. So if you look at the new Act, Section 163, I've just taken a small part of it. I'm reading subsection 1. For the purposes of this chapter, the expression international transaction means a transaction between two or more associate enterprise, one of which is necessarily a non-resident and includes, now clause A and B have skipped, I have taken the relevant part. Capital financing, lending or borrowing of money, including any type of long-term or short-term borrowing, lending or guarantee, or purchase or sale of marketable securities, or any type of advance or deferred payment or receivable, or any other debt arising in the course of business. So now incorporating this clause in the main section, we have done away with the requirement that the TPO is required to demonstrate that it affects my income, losses, assets or liabilities. So now if there is a guarantee transaction, definitely it's an international transaction. The TPO does not have to prove anything else. That is in 2025 Act. Quickly moving ahead, because time is a constraint to computation of ALP, you may be aware of the methods. You must have heard about these methods. Anyone who does not know the method at all, कभी सुना ही नहीं है? है कोई? Okay. Sir, when the two conditions are satisfied, that you are associated enterprise and there is an international transaction, you are required to demonstrate that the transaction is carried out at arm's length price. Now, arm's length price is not fair market value. Can anyone tell me the difference between what is arm's length price and what is fair market value? Anyone? Yes, sir.
After that means price which aren't slightly to silver. Of feeling a transaction. Fair market value will be different. The marketing of some kind of order to effect of one country. Different price also. Right?
Quite close. Yeah, you're right. Yes, sir.
So, price is what independent party
Ah,
might trade a particular item at or
yeah.
be on a particular day, right?
Uh,
Whereas the other one is more akin to intrinsic value. So, for instance, a share's price versus what hypothetical perfect DCF might give you. So, that's the difference.
अच्छा इतना अंग्रेजी में मैं हिंदी में समझाता हूँ आप टमाटर के ठेले पे जाओ when you go in the morning he will sell you tomatoes let us say at 20 rupees a kilo शाम को आप जाओगे टमाटर इज एज फ्रेश बट ठेले वाला नोज कि कल ये टमाटर मेरा खराब हो जाएगा so now he is ready to sell it even at 10 rupees beat any person because he knows the tomato won't last till tomorrow. Now, if you ask me that 8 o'clock in the night, what is the fair market value of that tomato? It is 20 rupees, fair market value. Ideally, the tomato should go at 20 rupees. But arm's length price is 10 rupees because वो टमाटर वाले के पास कोई रिलेटेड पार्टी भी आए या अनरिलेटेड पार्टी आए ही इज रेडी टू सेल इट एट 10 rupees. That's the difference between arm's length price and fair market value. Sorry, my examples are practical. I try to make it as practical or as understandable as possible. Please understand, arm's length price is not similar to fair market value. It may so happen in certain cases that your arm's length price and fair market value happen to coincide. That can happen. But arm's length price का एक ही तरकीब है. अगर यही ट्रांजैक्शन मैं अनरिलेटेड पार्टी के साथ करता तो would I do the transaction at the same value? That is arm's length price. आपको मैंने I started the session by asking you all that to reduce your tax liability you can pay 50 lakh or 1 crore rupees commission to your relative. You all readily agreed. Now to test whether that is arm's length price, I would ask you that to an unrelated person, would you be ready to pay the same amount? Naturally, the answer is no. So, in such case, I will say transaction is not at arm's length price. Now, the process of finding out arm's length price, कि arm's length price क्या है, उस प्रोसेस को हम कहते हैं benchmarking. क्या कहते हैं? Benchmarking. Now, these are all jargons. You know, all people who create international tax or they create transfer pricing, they create jargons just so that common public को समझ में ना आए. The process of finding out arm's length price is nothing but benchmarking. Benchmarking के total 6 मेथड है. One is comparable uncontrolled price method, resale price method, cost plus method, profit split method, and transaction net margin method. I will quickly go through this. As far as cup method is concerned, this is the most simple method prescribed in the rules. Cup method में आप क्या कर रहे हो? You find out an identical transaction. कि भाई यही transaction if it happens between two unrelated parties, then in that case, at what price would this transaction happen? So let's say this bottle of water, I am ready to sell it to my associate enterprise for 10 rupees. यही bottle अगर कोई non-related party बेच रहा है, तो वो कितने में बेच रहा है? That is nothing but your comparable price. So cup can also be of two types. One is internal cup and second is external cup. Let me explain with an example. Person A is selling goods to his associate enterprise B. That is my international transaction. Person A is selling goods to an unrelated party C. That is my comparable transaction. Can I say in both the transaction, person A is common? That is cup. That is internal cup. But suppose A is selling to B and C is selling to D. None of the parties are similar in the international and comparable transaction. So that is called as external cup. Quickly, if I may ask you, what is more reliable? Always internal cup. Because can I make a statement? पहला ही शब्द देखो आप. First word is comparable. That transaction between the international transaction between associate enterprise and the transaction which is comparable has to be comparable ना. उसमें differences नहीं होना चाहिए. When there is external cup, the associate invariably is going to find certain differences. Suppose I give you an example. I sold mobile phone to Virav Bhai, and there is a uncontrolled person, rather unrelated person selling mobile phone to another guy. You may say, sir, transaction is comparable. But now I told you that I sold him Apple phone and that fellow sold Android phone. Now tell me, is it comparable? Absolutely not. So product comparability is one of the crucial factors when it comes to cup. If the product comparability is not established due to certain functional difference यानी मैं जब मेरे एसोसिएट एंटरप्राइज को बेच रहा हूं आई गिव 3 months वारंटी, अनरिलेटेड पार्टी को बेच रहा हूं आई गिव नो वारंटी, एसोसिएट एंटरप्राइज को आई एम गिविंग क्रेडिट पीरियड, unrelated party को I am not giving credit period. These are called as functional differences. Functional differences can be erased. That is fine. But if there is a difference in the product itself, the comparative transaction itself, then cup may not be most suitable method. Method total है 6, उसमें से I have to select which is MAM, more appropriate method. So if there is a product comparability, take use of cup. If not, then please leave this method. I'll quickly go ahead to the next method, if that is okay. If there are any doubts on cup, you can ask me. I have to finish the methods and then one more slide. Can I proceed? Yes, ma'am.
In case of internal document, quantity can also affect.
Quantity can also, but that may be a functional difference. You may be able to erase, because if there is, let us say, a situation where a person orders in bulk, so I have given him quantity discount. So I can always say that if same transaction took place between non-related parties, then what kind of discount would be allowed? But product ही अगर अलग रहा, then cup may not be suitable. One point I would like to add, that in case of cup, I hope you understand, finding out such comparable transaction may be difficult, especially when there are no internal cups. Internal cup रहा तो आपको ही पता है ना, common sense. अरे yes or no? Okay, I am not going through the illustration. My PPT will be shared, so at that time you can go through the illustration. Otherwise, this is a very simple basic illustration to understand. Any other doubt anyone has in cup? Okay. Suitability, unsuitability I have already covered. Next is resale price method. Resale price method applies only in one situation where you are a distributor. If there is an Indian enterprise which purchases from its associate enterprise who is a non-resident and then resells in the Indian market, then this method is applicable. It applies only in one type of situation. I purchase from my associate enterprise and then I am reselling it in the Indian market. In no other situation RPM applies. Let us say I purchase from unrelated party and resell it to related party. This method does not apply. I purchase from related party, I sell it to related party. Again, this method does not apply. It applies only when I purchase from associate enterprise and resell it in the to non-associate enterprise in the market. As far as RPM is concerned, this method is to be applied only when I am a distributor. If I am a manufacturer, अगर मैं raw material purchase करके उसमें value addition कर रहा हूँ, then this method does not apply. Okay, appropriateness and limitations is fine. The next method is cost plus. At any point of time, I'm just going through these methods because most of you all may be aware of the methods. An example you can go through. It's not like any rocket science. It's a simple example. Cost plus method, quite simple. You must be aware of your costs. Who is aware of the cost? Manufacturer. So generally in case of manufacturers, this method would be applied wherein you add all your direct and indirect costs and you add a margin which is taken to be the normal profit margin, and that will be used to arrive at arm's length price. Even in case of resale price method, I take the resale price, I reduce the normal margin in the industry to arrive at my arm's length price, and that will be compared with my actual purchase price. ये मार्जिन कहाँ से हम पता करते हैं? नॉर्मल प्रॉफिट मार्जिन फ्रॉम वेयर डू वी फाइंड आउट? देयर आर डेटाबेसेस. बेंचमार्किंग में बहुत सारे डेटाबेसेस हैं. कैपिटल लाइन है, प्रोवेस है, कॉम्प्यूस्टैट है. देयर आर मेनी डेटाबेसेस. From there you can find out in your industry what are the kind of margins which are available. Okay. How to identify the margins? I think will be covered later, because in case of margins also you may apply certain filters. Let us say I am a pharmaceutical company. My turnover is 10 crores. My Glenmark cannot be my comparable. Glenmark का 10,000 crore का turnover है. So in case of comparables also, I have to see those comparables which are more suited to me to identify their margins. Okay. After cost plus, the next one, again an example is given. You can go to that. Profit split method. As far as profit split method is concerned, that is very rarely used method practically. However, just this morning we were discussing that Virav applied profit split method in one of his transactions earlier. In case of profit split method, what we do is, it applies generally in case of unique intangibles. So let us say two or more enterprises are working together, associate enterprise, and they are working on a project which involves manufacturing of a unique intangible. Let's say coronavirus का vaccine. It's a unique intangible. पहले कभी बना नहीं है. So in such case, what you do is, you first find out what is the total profit of that project. What is the total profitability? And then you split it amongst the entities based on the relevant contribution factor of that particular entity. So if you look at step number 1, you first determine the combined profit from control transactions undertaken by the associate enterprise. Identify each associate enterprise's relative contribution based on FAR analysis, function asset risk analysis. Whatever you earn, your margins are based on 3 things. Correct? Whatever you earn, either functions performed or assets employed or risk that you undertake. Think about it. Anything that you earn, if you earn rental income, so you must be having a house, right, which is given on rent. So that is assets employed. If you do a business, then you are undertaking a, good morning, you are undertaking a risk. Okay. Then you allocate it amongst the entities based on their relative contribution. Last is transaction net margin method. Transaction net margin method, I always call it as the other sources of benchmarking. 90 to 95% transactions are generally based on benchmark based on TNMM, because in TNMM there is a scope for aggregating the transactions. You can find out the profits based on aggregation. तो आपका एक्चुअल ट्रांजैक्शन शायद उसके अंदर छिप जाए. That TPO tries to ask you for segmental accounts, and you may say that I am not required to maintain segmental accounts as per the accounting standard, and therefore the entire profit margin of the entity has to be considered for benchmarking the transaction. The concept is very simple. If I undertake transaction with my associate enterprise, I am earning 20% margin. However, my comparables are earning 18% margin based on the database I identify comparables. So can I say I am earning more? So my transaction is nothing but at arm's length price. If I earn less, then there is a problem. Comparables में भी एक issue आता है. At the comparables that you reject, आप करते हो ना accept reject matrix. So you are required to identify the reasons why you are ignoring certain comparables. Otherwise, the TPO may allege that you are doing cherry picking. You are only taking those comparables where margin is suiting your purpose. I am sure my friends from Big Four are smiling. So that is as far as TNMM is concerned. I'll quickly just wind up in 5 minutes because other things are also to be covered. Any other method? So if there is a share transaction, तो आप शेयर ट्रांजैक्शन जब करते हो, बाइंग ऑफ शेयर, सेलिंग ऑफ शेयर्स, इशू ऑफ शेयर्स, तो व्हाट इज द वन थिंग दैट यू ऑब्टेन? वैल्यूएशन रिपोर्ट. अर्लियर सब चीजों के लिए सीए का वैल्यूएशन रिपोर्ट वाज अलाउड. नाउ सीए इज बैंड for issuing valuation reports as far as issue of shares are concerned, and one of the reasons is what? Reverse engineering, isn't it? People do reverse engineering. I had one case where the in tribunal where my friend had issued a valuation report. He's also a practicing chartered. So I told him, "Arey bhai, इसका actual achievements, the revenue is 1 lakh, 1.5 lakh, 2 lakhs, and in the projection, it is showing crores." I said, "How do you reconcile the two? There's a 95-98% gap." So he said, "No, no, price पहले से fixed था." So then we went in the reverse engineering process to arrive at turnover as the balancing figure. I mean, don't do that if you are issuing valuation reports. Choosing the most appropriate method. So depending on the nature and class of transaction, depending on the nature of the assessee, you are required to choose which is the most appropriate method. Two last points from my side. First is, if you are aware of section 9, section 9, if there is a business connection of a non-resident in India or under DTAA, if the non-resident has a permanent establishment in India, think logically and tell me, merely because non-resident has a PE in India, would his global incomes be taxable in India or the profits attributable to that PE? Naturally, that profits which are attributable to the PE, those will be regarded as the taxable profits in India. How to do that attribution? For that also you can use these very methods for attributing the profit. So these methods, as held in Morgan Stanley's case, that attribution of profits has to be done once there is a PE established, and that attribution can be done based on the TP methods which we just saw. And the last point, whether advertisement, you can go through the case later. Yeah, I would just read one sentence, the third para of decision of Supreme Court in Morgan Stanley, that the court endorsed the use of TNMM, transaction net margin method, as a reliable and appropriate method in such service arrangements, especially when Indian entity operates as a captive service provider with limited risk. So you can use the benchmarking methods for even attribution of profits to the Indian permanent establishment. And the last is whether bright line test is prescribed under Indian law. There is no such method as bright line test prescribed in Indian law. There was some very enterprising TPO. He saw a case of Canada. Canada में ये bright line test is prescribed. Now what happens in BLT is that suppose in your industry, let's say you are in auto industry. In auto industry, all your comparables, all your competitors are spending 12% of their top line towards advertisement. आप खर्चा कर रहे हो 15%. So how much excess are you incurring? 3%. Now, as per the TP laws of Canada, that can be regarded as a benefit given to your main associate enterprise because your brand name is same. आप सब्सिडरी हो कनाडा में, आपका मेन होल्डिंग कंपनी में भी इन यूएस और इन द यूके, so that extra expense that you incur can be regarded as the benefit created to the associate enterprise, and that can be recovered from the associate enterprise. However, in India, transfer pricing officers have tried this, and courts have consistently held that you cannot regard bright line test as an appropriate method. Let us assume that first and foremost for AMP expenses, advertisement, marketing, publicity expense, whether you are having an understanding with your holding company, because I told you transaction होना चाहिए. Mere incidental benefit, I incurred AMP cost that resulted in a benefit for my associate enterprise, that cannot be benchmarked. Transaction ही नहीं है. But if I have a transaction, if my holding company or my associate enterprise orally or in writing told me to incur AMP expense, due to which I have incurred, then that can be covered within the purview of international transaction. However, even then, Supreme Court of India, Delhi High Court and even Supreme Court has held that as far as ALP is concerned, that cannot be determined by bright line test. So second para you can see the court rejected the bright line test, stating that it has no statutory mandate and was not supported by Indian transfer pricing rules or international practices. The universal application was seen as a judicial overreach. So Canada mein hai, how can you apply it in India? And the court noted that it cannot be used as a mechanical formula to determine non-routine advertisement marketing publicity expense. I hope this point was clear. Okay. So with that, I come to an end of my session. Thank you so much. If you have any doubts, and make them happy, or I can pass on the baton to the next speaker. Yes, sir. You have a doubt? Quickly.
Relating to credit receivables and trade credit.
Yes.
Sir, अगर कभी भी आपने 100 रुपीस का वो सेल किया है डिविडेंड,
Yeah.
तो it's outstanding for more than 1 year. I am assuming. So how do I report this?
So, sir, first and foremost, the stand that we take is that credit period का जो margin है, the extra margin, I have already incorporated in my selling price. You will have to demonstrate based on that. कि credit period का जितना भी time value of money है, that is included in my margin, and that margin is at arm's length price. There is no other way to demonstrate it. However, let's say to your non-associate enterprise, you are not giving any credit period, and your associate enterprise you are giving extra credit period, then again that can create an issue.
फर्स्ट केस में जो इंटरेस्ट पे ट्रांजेक्शन हुआ है, वो रिपोर्ट हो गया.
Yes.
अभी सेकंड जब वो कन्वर्ट हो रहा है ट्रेड पेबल से ट्रेड रिसीवेबल, सो उसका रिपोर्ट जो वापस कर
जो सेल और परचेज है उसके नीचे ही आपको लिखना पड़ेगा.
ऑब्जर्वेशन.
Yes, as an observation, because you will have to state that as far as the assessee is concerned, the assessee believes that the receivables time value of money, the receivable margin is already included in the sale or purchase price. You will have to state that.
Sir,
Yes.
small,
Yes, sir.
like a manufacturer and the products are not comparable, like
Yeah.
a unique product. So then usually like cost plus method to use.
Cost plus method you can use depending on which industry you are in. आपकी इंडस्ट्री में other players are there, may not be same product, but are there other players in the industry? If yes, तो cost plus में आप margin add कर सकते हो. या फिर अगर आपके इंडस्ट्री में कोई प्लेयर नहीं है, but you want to adopt TNML, then you have to be very careful in identifying the comparables. You have to be a bit careful.
Those comparables are not available then.
If I may ask, you are manufacturing what?
Like a specific like a railway part for a US, like
Acha.
it's applying to like a global customers.
So maybe what you can do is based on FAR analysis, you can broaden the scope of your comparables by saying that there is no comparable for actual manufacturing of my product, but there are other manufacturers who supply to the US in similar circumstances, and they can be regarded as my competitors.
Is that comparable available in the market or
मैन्युफैक्चरर तो बहुत सारे हैं, हेवी इंडस्ट्रीज के जो मैन्युफैक्चरर हैं, they are exporting also to the US.
so whatever data available in the public domain that can be used.
Better you use databases. I had a client who went on ROC website and identified 4 or 5 companies, and he said, I'm taking that as comparable. Then in that case, the officers also have prowess. So they may send you a big show cause identifying 30 comparables, and they say, tell me why this should not be adopted. So then it may create an issue. Better to have a benchmarking. Benchmarking में एक्सेप्ट रिजेक्ट मैट्रिक्स जो रहता है उसमें आप प्रोवेस का ही डालते हो, प्रोवेस एंड कैपिटल लाइन का. The officer already knows that these comparables are considered but rejected due to some reasons whatsoever. Afterwards, sir, it's a request. I take one last query, and or maybe actually we are running late. We will take the query towards the end if that's not an issue, because we are getting late for the other session. Thank you so much. Thank you, everyone.
On behalf of WARP and ICA, I sincerely thank PA Saurabh for sharing a wonderful session and insight on topic of transfer pricing. I'm sure you must have enjoyed with his realistic example, especially the Ramesh Sarkar Jelewala is a very fantastic example to understand the topic. We will not take a break and we will continue the session. Our speaker is ready. And once again, thank you, sir, for sharing a wonderful session. Oh. All the queries of the participant will be taken after the session. So if you have any query, just no.
Regarding query only, I have an announcement to do. We have around 10 study groups in WRC. I am heading direct type study group, and we have started one venture under guidance of our chairman. That twice a month we have a help desk, whereby we are asking queries from the members on Google Form. We assign 2 days. One is 10th and one is 24th of every month. Likewise, we have in GLT also and RERA also. So looking at the response from the members and the queries they are raising, and we know transfer pricing is very technical issue, and one solution for A is not suitable for B. So there will be unique queries. So in the morning, Mangesh sir was here. He was the chairman of the committee. I will suggest him to have one help desk for transfer pricing also, and we'll see. And very as much as possible earliest we will come to him, and we'll announce that. I'm informally announcing it, but technically how to I need how to go for it, and the faculties like Viral and sir is there, so वो definitely हम लोग कर ही लेंगे. Without taking much of your time and without further ado, we'll start a new session, and we have it Virav Dedhia, and he's going to deliberate on the topic. The implications of transfer pricing assessment, very important. इसीलिए लोग आए हैं यहाँ पे, and management fees and intra-group services. So, friends, we'll start right away. I would request Ravi to introduce today's faculty.
Thank you, Sanjay sir. We have with us CA Virav Dedhia, a very renowned faculty. He is a professional chartered accountant who has a more than 14 years of experience in international taxation and litigation, which revolves around the transfer pricing and international taxation. He is a professional who is specializing in transfer pricing, compliance, business restructuring, representation strategies, and many more. He has been the active part of advanced pricing filings and negotiations. The clients served were engaged in the oil and gas industry, infrastructure industry, and consumer goods. He has been a speaker at various forums and also contributed articles on various platforms, including WARC of ICAI, which conducts the diploma course. He also contributed at Economic Times, Economic Masterclass section in the topic called taxation. He has also contributed at the Deloitte AP ACE training slide and the many more platforms. He also co-authored the article on angel tax, which is published on the Tax Guru website. And he also co-authored the article on transfer pricing challenges during the COVID period on the taxman.com site. He also co-authored the budget newsletter, which is prepared by an NGO since last 5 years. So we welcome the CA Virav Dedhia with a big round of applause. Before starting the today's session, I request CA Sanjay sir to felicitate CA Virav with the memento.
If you have some queries which are not addressed here due to policy of our side, you can write down and you can submit here. We make sure that at least one email ID and mobile number will be there. This is possible every time. That's
Good afternoon, friends. Uh, I think after a very informative session by CS Saurabh, I very much pleased and to take up the next session, which is more to do with the assessments. I think we have all dealt with our own compliances part. Compliances are already there now in sunset, and now the season for assessments will come up. I'm sure many of us would have already got notices for AY 23-24. Along with that, AY 24-25 also the notices have started to come because the officer wants के रुमाल डाल के रख देते हैं बाद में देखा जाएगा. So that's the thing. So myself, CA Virav Dedhia, and let's start with the contents. So what we'll be covering is basically the regulations governing the TP assessments, particularly the history of TP assessments, peculiar issues, documentation, and the benefit test which with which we can justify our transactions, the benchmarkings which would be required for those transactions, and how safe harbor provisions can help us to go ahead and make the transactions to be, or we can justify our transactions in that sense. So that's the whole thing that we will be covering up. In case if there are any doubts or something, please stop me then and there. Please ask me. I'll try to address as many doubts and as many practical aspects that I have learned over the period of time, so that we can have an enriching session. I'll also request that it has to be an interactive session, otherwise it will be boring. And I know it's just before lunch, so इसको भूख भी लगा रहेगा बाद में attend में. So let's start off. The regulations which are governing the TP assessments, those are covered in Chapter 10 of our Income Tax Act 1961. Apart from that, we also have OECD and the UN models. So, the Indian transfer pricing regulations are references drawn from these OECD regulations and also the UNTP regulations. So we don't actually follow them, but we take references from them, and then we have drafted our own regulations. Then we have case laws. Of course, looking at the earlier presenter as well, when we see there are many case laws which have been come through, there have been various interpretations which have been come through. So those also form part and parcel of our regulations. And of course, the sections 92A and section 92BA, which is more to do with the specified domestic transactions. Those are our key analyzers whether any transaction is a arm's length or is a international transaction or falls within the ambit of the provisions for transfer pricing applicability. If we see the recent developments which are in the field of transfer pricing assessments, what we see is that we are now moving towards the block assessment kind of a model. So earlier, each year was being analyzed separately. From now, there would be an option which would be available to the assessee to have a block assessment where 3 assessment years would be analyzed together. This would be very beneficial in case where the assessee has similar transactions for a year-on-year basis. So, say for example, one is a limited risk service provider. It provides services only to its any related party. So over there, we can use this kind of an approach and say that, one particular assessment for 3 years in a block, and we are two. Usually, this kind of an assessment is present in Germany. So German laws provide for these block assessments, and now India is slowly adopting these kind of assessments in India as well. The applicability of safe harbor, as I said, those are benchmarks which says that you apply these rates or these profitabilities that you apply, and there would be no questions asked from the assessing officer, and you can sail through. The current safe harbor provisions were applicable only till the last assessment year, that is 24-25. Just recently, on 3rd of November, we have received a circular which says that this safe harbor provisions would also be extended to AY 25-26 and also for AY 26-27. The scope for the safe harbor has been widened to also include manufacturers of lithium ion batteries along with the manufacturers of auto components. So earlier, only service components were there or service providers were there. Those were low value adding service providers. Then there was addition of high value adding service providers. Then, slowly and steadily the list got widened up, and now lithium ion battery manufacturers are also getting covered. There's a program which is called as advanced pricing arrangement, wherein an assessee has liberty to go and have an arrangement, a formal contract with the Ministry of Finance to have a discussion, a proper formal negotiation discussion about the pricing that it may have for the next 5 years and also for the past 4 years. So total 9 years it gets covered. This is a very successful program, and last year around 125 APAs were signed, out of which 39 were bilaterals. Now, bilateral is such a situation where it's not only a discussion with the Indian tax office or Indian revenue department, it's also discussion with my related party and country's finance department. Okay, so that's the wide range that we have. Moving to the history of TP assessments, as Saurabh mentioned, we have introduced the Finance Act 2001 was the one where transfer pricing was formally introduced. Then we had the Vodafone case law, which was started off in 2005, but the decision came in 2014, and it has been very well discussed in the earlier presentation. Then dispute resolution panel and APA were introduced. Now, dispute resolution panel is a panel of three commissioner of income tax. Those and a SSE can apply to a dispute resolution panel once the assessing officer has issued a draft order. So draft order is and DRP is such a kind of a model which runs parallel to CITA. CIT appeals would be only one CIT who would be hearing your case. Here we would have three CITs who would be hearing your case. The benefit of going to DRP is that there is a strict timeline that within 9 months you have to issue the directions, and then on those directions the assessing officer will issue the final order. Now, because the final order is getting delayed, Section 156 ka demand will not be raised, and there would be a complete stay on demand till that sense. So if we have and usually the outcomes is such that it is the DRPs and the CITAs usually follow what the juniors have done or what the first level officer has done. So we can always say that it's a kind of a fast track mechanism to go to the ITATs per se. Then in the year 2013 and 2016, OECD introduced the concept of BEPS, which is base erosion profit shifting, where we say that the base or the tax base from one particular country is shifted to another country, and there are documentations, and there were 15 action points which were now so they were earlier called as action plans. Now they have been converted, and they have been passed by the OECD, which has been now stated to be as actions particularly. And action 13 says or covers the country by country report, which is fondly called as CBC reports, master file, which is the main report or kind of a policy document for the entire group. And then we have the local files, which are called as the transfer pricing study reports. Then also the concept of range was introduced in the year 2013 to 2016, where the earlier ranges or the globally accepted ranges are 25 to 75 percentiles. We have our own narrowed down range of 35 to 65. In Malaysia, the range is even more narrower, and they have followed India. They are at around 37.5 to 62.5. So that's the it's becoming narrower and narrower. But yeah, the developed countries still say 25-75 is much more easier to compute, and we are fine with it. Then secondary adjustments were introduced in section 92C in 2017. And the last in 2018, where the assessments are now moving towards, from value of transaction basis to the risk model basis, where we say, okay, this particular transaction is more riskier. Let's analyze this transaction and let's scrutinize this transaction. Where more emphasis is now given on transactions like, business restructurings, intangibles, and the intragroup services. With the more favorite one being the intragroup services, because we'll see in the next slides how and why they are more favorites. So peculiar issues. What I have done is I have, based on the experience and the current trends in the assessments, I have divided the adjustments or the transfer pricing focus or of the officers into two parts. One is the low hanging fruits, and other is the key issues, okay, or the other issues. So in low hanging fruits, can anyone say what would be the first one? I'm sure you all must have faced some or the other assessments. So what would be the very prominent one which is being there? Exactly. So management services being the first one. Then there is always low value adding services, which is something like rendering of BPO KPO services. So all these are very peculiar items or low hanging fruits. Then we have innovation or R&D fees ka allocation. We have AMP, which is advertising, marketing, promotion expenses. We have corporate guarantee fees. We have interest on overdue receivables, as my friend was just speaking about. And then we have other issues, which are relating to say economic adjustments and allocations, supply of free of cost goods or services, ESOP, because this has been very much in trend nowadays, um, and the exit charge for the business restructurings. So I'll try to cover as much as possible, and we'll see how the documentation, benefit test, and the benchmarkings take place for each of them. So first, let's start with the low-hanging fruits, and the first one being the low value adding services. If I have to present a classic, transaction, it can be where there is a cost contributor. So, say for example, there is an entity in India which is say BPO, which provides customer care service centers for say Walmart INC, okay, which is based out of US. So the US, if at all there is any kind of US customer wants any kind of a customer support, they will dial in some XYZ number, and that number will get moved to India. Okay. So in that sense, what happens is the cost contributor or the low value adding service provider will add up its own costs. It will add some kind of a markup, and it will charge to the holding company or the service receiver entity. In case if there is more than one service recipient entities, say for example, Walmart is just present in not in US but in US and also in UK. Okay, so what usually entities do is they pool in this cost into one central entity, which can be a holding entity or a cost pool entity, and then this pool is then getting allocated amongst the service recipient entities or the entities who are mainly operating entities. Now, the operating entity is an entity which eventually serves the third party customers. Okay. So, what happens is this particular arrangement it can be such that there are certain operating entities in India for whom the allocation charge would be coming in, and then there would be some service providers in India for whom this particular markups will be tested. So let's see the definition first. So it says low value adding services are intercompany services that provide minimal economic value to the receiving entity, and these services typically assist the multinational corporations in their primary business activities without significantly contributing to the profitability or the strategic decision making. So say, here when I gave the example of a call center, it does not you know have any kind of an importance, or I would say key importance to the main business functions. It is always supporting to the main business functions. OECD, if I have to see in chapter in BEPS section 10, low value adding services are defined as supportive in nature, non-core business activities, do not use any kind of intangibles. So when we say intangibles, they can also include trademarks, manufacturing processes or something of that sort, and they do not involve any kind of assumption of significant control and risks. So when we say significant control, those are majorly, they cannot, a BPO service provider in India cannot have any kind of a significant play in the decision making of the strategies of the holding company or the main operating entity. So as we said, what would can be the examples of low value adding services? Accounting and auditing services which provide. Now this includes internal audits, not the statutory audits. Human resource services, IT support, which is very common to provide. Legal services, because this can be more of document drafting and document. I would say on the drafting side, not on the vetting or legal. Uh, Advisory services. Then we have tax compliances, say GST services, GST returns, or VAT returns, as it may be for other countries. Then we have general administrative supports, which are relating to admin operations. Then we have health, safety, and environment monitoring. Now, this is being coming up very lately because many of the manufacturing entities are required to have, and engineering entities are required to have HSE compliances. So that will also get covered here. Let's look at some examples which are not covered as a low value adding services. Those can be research and development services where you are innovating any new product per se. It involves significant use of brain and technical analysis. Manufacturing activities, sales, marketing, and distribution activities, because many a times the value of any kind of an enterprise would also be attached to the distribution chain or the distribution model that it can have. Now, I have to give also say for example, if I give a classic example of Amul milk, okay, it is available right from the collection center in Gujarat till the lowest of the lowest kiosk, which would be say गली का नाके पे जो मिल्क सेंटर रहेगा वहां तक भी अवेलेबल है. So that's the kind of thing. If we look at HUL, which gives, or Pulse, the most favorite candy that we see. It's available to the lowest of the lowest distributor. So that's the kind of distribution model which also classifies to be as an intangible at times when we value the business. Then there are business financial services, which include, treasury operations and all those factors. And the corporate senior management services, the group CEOs, group CFOs, and all those things. When we look at the safe harbor for the receipt of these kind of services, because as I said, the operating entities can be in India and they can be receiver of these these allocations as well. Safe harbor has provided a markup of 5%. So in case your related party is applying say cost plus 5%, so there can be a we can apply a safe harbor provision, and we can say that the transaction is at arm's length. The 5% markup is in line with what OECD has told for where we have to say that these are there on 5% and OECD recommended rates basically. Um, but the only catch here is the 5% has to be certified by an accountant in the region where the associated enterprise is. So, say for example, we are receiving services or low value adding services from, say, another low cost jurisdiction, which is, say, Philippines, into India. So, we have to ensure that someone in Philippines, an accountant or CA in Philippines, is certifying that these are the costs, this is the markup, and this is what is coming to India. Okay, so it has to be through a proper accountant certificate.
In case of GCCs which are now coming up, would this be applicable? Because they would be serving the entire geography.
Right. So it would be applicable. So GCCs, as I said, if they are providing these services, the services on the left side of mine and right side of yours, so then it would be of course covered under this kind of an area.
So the foreign company providing the services to India.
Yes, for the safe harbor. But when if it is India company which is providing, then I'll just come to those aspects in the next slide. So if it is a recipient, then 5% markup is fine. Otherwise, India has a higher markup usually. So pricing methodology as per OECD, as I said, we first identify the cost, we pull it together, we exclude certain costs which can be easily identified that okay, these are the costs which are specifically to say this entity, these are the costs which are specifically to Y entity. So we may exclude those costs. Reimbursements which can be if say group company has incurred some cost on behalf of the Indian entity, then those costs can be excluded. A standard markup of 5% is what OECD says, and then it has to be allocated on a rational basis, which can be on the revenue model basis, or it can also be on the time cost. So, say for example, if the accounting services which are being received from say Philippines is there are three entities, so India, Middle East, Singapore, which are receiving these accounting services. So it has to be either on time basis, कि किसमें कितना time गया, or on revenue basis, which entity is larger, that entity can be absorbing more cost, or any other par. The function, asset, and risk model is where we see okay which entity is performing more complex functions or more functions. On that basis, we can do an analysis. In India, it says all costs, which are direct costs, indirect costs, everything. But non-operating costs like say provision for gratuity or any other provisions which are disallowed in the computation of tax, that is excluded. Markup of at least 12 to 15% is what the Indian tax officers would ideally want for these kind of transactions. But if we see the safe harbor provisions say all costs again, excluding the non-operating costs, of course, and then markup of 20 to 25%. So that's the range. So 20% is usually for entities having turnover up to 10 CR. If it is above 10 CR, then the markup raises by 22%. So 2% increase in that percentage. So that's the you know
20% of what?
20% of the cost.
Yes.
Total cost, which is all direct, indirect. Now indirect can include your administrative costs, rent, anything and everything else.
So that also to be included in the cost, indirect cost.
Yes.
Then
Yes. So, say for example, India is providing services of accounting services, or in my earlier example, Walmart, where India is the call center. So, all the employee costs plus my facility cost, which is the rent of the premises, plus there would be housekeeping staff, etc., etc. Bus services which might be there. So, even those costs get added, and then markup of 20%.
it's paying for the service,
Which India would have provided to the
service,
yes services.
not on product.
No.
And it doesn't charge then. Sometimes say it's a small
Hmm.
value,
Hmm.
but doesn't charge it. Provide a service, but there's no account.
No, but then it is actually a transaction, right? So if it is a transaction, you will not do any transaction for free. If I have to, then you would always be exposed to some kind of adjustment with the tax office during the time of scrutiny. Because if they identify, okay, you have provided these services, but you haven't charged any kind of a markup, or you haven't charged anything for that matter, you would not do similar kind of social service to any third party, right? You would always want there would be some profit element which you would have earned. So that's the thing, and you would be exposed to any kind of an assessment and addition during the kind of.
The cost is not explicit. Like one company paid for a machinery, and the Indian company only paid for like a custom duty for that. How do we assess the cost of use of that machine?
So
We have
that
to like
machinery.
emotional cost or
No, so all cost means all cost because it's captive service provider. So even if the cost of a customs, okay, if say laptops are specific kind of laptops or you need specific kind of telephone machine, which has to be imported from a foreign country, and the Indian entity has paid for the custom duty, then that has to be added in my cost base because how will you do a journal accounting for that? You would always put say expense account debit to cash or bank. It has to be added. Yeah. That's based on my experience. That basis of the the databases that we do and the searches that we done. Yes. Yeah.
So, sir, basically, business support services or something like that would be covered here.
Yes.
So, we can go for PNMM or the general search option.
Yeah. So when we see it says all costs, so all costs are all costs. So if we see TNMM, it says net operating or net margin method. So net margin because in services we cannot identify gross profit, right? We have to any which ways go up to net profit margin only. So that's where the TNMM would be applicable. Okay, so let's move to the next one. So, what are the documents which would be required and which can be helpful during the time of TP scrutinies? Would be first is agreements. Now, these agreements would be specifically requiring various clauses, especially nature of services. It has to be very much precise and I would say very much clear about what kind of services are being provided by each of the entities, okay, the recipient entity and the giver entity, which has to be documented in a proper function, asset, and risk analysis. As to first, why is it important? Now, when we say the same example of call center, why is that call center business important for the recipient, service recipient? What benefit will it receive? And if at all there would not have been, this particular service provider was not there, or the call center was not there, would it be such that any third party would pay for similar kind of services? And is it a shareholder activity? I'll come to shareholder activity in some time from now, but just understand that if you are the owner of some particular company, you would always invest some time for which you would not expect anything in return because the return would be say increase in the value of your share. So that kind of services or that kind of time devotion is usually called as a shareholder activity. Then you can also keep email exchanges, working files as basis, which can be going ahead and put forward before the tax office that okay, see there are these email exchanges which say that service has been received or given, and there are directions coming in from the related party. Okay, you provide services in this manner, or this is what we need additional or something. Then we have virtual or physical meetings which may be conducted. So say there can be meetings with regards to the Indian directors and the foreign directors saying that okay, this is what we are now planning to do, or this is what has been introduced. So you may guide the team accordingly. There would be trainings because the service provider they wouldn't provide services without any expectation from the service recipient. So it has to be through trainings which can be provided by the service recipient. Clear till here? Any more doubts? Okay. So let's move to the next one, which is management fees. Yeah, yeah. Hmm. Okay. So payroll details, what you can do is you can hide the names. because usually the names are subjected to privacy regulations in India. So you can hide the names, you can give the designations, and you can give the amount of paid monthly salaries that you pay to them. So that can be provided because the designations are more important for the tax officer to understand what kind of employees are being hired. Is it such that you are hiring low value, or just fresher, graduate fresher, or you are adding someone in the middle level or in the top level? So that can be analyzed through that. So that can be provided. Okay, so management services, as we said, that if at all there are group CEOs, group CFOs which are sitting in the holding companies, they would obviously give services relating to guidance of the business and all to the subsidiary entities. These subsidiary entities would be, I take the example of PNG, okay, so, or HUL, where Unilever is based outside of India and Hindustan Unilever is based in India. Unilever would provide guidance. Okay, we have to start with XYZ products, and we have to ensure that these meet XYZ market criteria. Target is this, etc., etc., etc. Now, this kind of guidance which comes in from the global, or from the group CEOs, they can be distributed between three line items. First one would be, it can be a subsidiary, so it can be a shareholder activity, it can be a duplicative activity, and it can be a value adding activity. Okay. So now we have, when we see if it is a shareholder activity, as I already explained, that when you are a shareholder, you need to obviously devote some time so that your value increases. If it is duplicative, it should not be such that the subsidiaries, they also have their directors. They are also performing the same function which the group CEO is already performing. So those can be duplicative in nature. And then there would be value adding. So you have to ensure, or you have to see whether the group CEOs or group CFOs are adding some kind of value to the entity's existence in India. Okay. Let's look at the definition. First, as the trend says, let's go into OECD and then into India. So OECD says, Chapter 7 guidelines. Management services are a subset of the intra-group services, which is the low value adding services. So kind of a subset of that, where services are provided by one entity within the MNE group. Okay, so now in transfer pricing, we don't say MNCs, we say MNEs, which is multinational entities, from one group entity to the another group entity. So that's the, and these services are typically including which are strategic in nature, as I said, group CEOs, group CFOs, services which require certain level of educational qualification and or experiences as well. These services are not routine in nature, they don't interfere with the day-to-day operations of the business, and they help in making the decisions. So the decision making capabilities are also present with the service provider. And the last is risk management. In case if there is any kind of risk, say for example, HUL says your XYZ fruit juice of Unilever will not work in India, and India market will more cater or will more be adaptive to chas. Say for example. So in that sense, the risk management or the decision of whether to introduce that fruit juice or to whether to adapt to chas would be taken up by these holding companies. So that's where the risk management and the strategic decision making capabilities lie. So examples, can anyone help? Who would be or what would be the examples of management services?
Legal service, decision making.
Right.
Salary cost of CFO in that case. Like
Shared
CFOs.
service.
Yeah. So shared services, can you be more specific?
Accounting, HR related service.
Accounting, HR, we already covered in low value adding, so those would not be as management services. So if you can say, group HR.
Getting the business for that like company,
Hmm.
like means holding company
Hmm.
is discussing with the customer, getting the business for the
So you can say marketing or commercial team, group commercial team. Yes, of course.
Valuation.
Yeah, valuations or the strategic M&A related activities.
Eventually,
Yeah, of course. So administrative activities, of course, which relating to the group CEOs, CFOs. Technical support with regards to say M&A activities or something. financial services, which is the group treasury and the group financing, which usually takes. Commercial services, as we said, getting businesses for the entity. Strategic planning, which is done by the groups, product officers or something. And coordination and control functions, which are more about if the functioning of the group is being and subsidiaries functioning in accordance to the group policies. What are not part of the management fees, which are low value adding services, like that's the administrative functions or relating to say HR or day to day management functions. These are not shareholder activity, duplicative activity. As we discussed already, what are shareholder activities and duplicative. So those will not be covered here. Let's move to the pricing element about how these services would be priced or can ideally be priced. And so, as we say, the cost pool, because these are again services, so we'll always go to transactional net margin method or TNMM for the purposes of our analysis. We identify the cost pool because say group CEOs or group CFOs may or may not necessarily be sitting in one of the offices. Say group CEO is based out of head office, which is in say US. There can be a group treasury which will be say sitting in say Europe somewhere or something of that sort. So all those costs have to be pulled in together. Then certain costs which are relating to the group as a whole or to some specific items have to be excluded. So say for example, Unilever Inc., which may be a listed entity in US, incurs certain expenses on say CS compliances or say listing fees, which it pays to the listing or of its securities. All those costs should be ideally excluded because those are not relating to the or the benefit would not be received by any kind of a service receiver. So those costs can be excluded. And a standard markup, again, 5% is what OECD says or recommends. So that is where it goes. And the allocation keys can be again, the third party allocation, as we discussed in the earlier part. It can be revenue, which would be only third party revenue. So say for example, there is a service provider or there is a operating entity which provides services only to the related party. Then in that sense, we would always recommend that the management fees is not allocated to them because they are considered to be an extended part of the main entity itself. So ideally, it goes only to the entities which are catering to the third parties. Per se. Then number of FTs. FTs mean the full-time employees. So if we can be also divided on the basis of full-time employees. The time cost of say a group CFO or C-suite is how much time are they allocating to whom, but that is usually very difficult to identify because if at all a group C-suite is in a conference or something, they may mention about India, they may mention about any other country. So it becomes very difficult to, gauge their time. So, and the last one is the PAR, which is, the function which each of the entities. So maybe the revenue would be less, but that entity is very much crucial to the main group. So then that entity will have additional amount of management. Then we go and yeah. These markups are minimum or recommended? So OECD has mentioned an up to 5% of things. So these are the higher ceilings. And if you see on the other side, the markups as per the Indian regulations are mentioned, which is 15%. This is again on the basis of my experience of search conducting on various public domains. So this is the usual markup which comes up. But if we see the safe harbor provisions, then it's pegged at around 25%. So which is where it says that because these are value adding services and these require employees which are more crucial or critical to the businesses, so they usually recommend higher markup. Any doubts on this?
So if I may
Yeah.
ask, what is the difference in OECD and TP benchmark? Say,
So OECD is a group of organizational economic and cooperation development entities. India is not part of the OECD group. It is just it takes references from them to prepare its own regulations. So though OECD may recommend 5%, but India may say that okay, 5% is not good for India. We may recommend a higher.
So this is like international benchmarking.
Yeah.
OECD, we refer it to international benchmarking, not completely applicable for India, but for Indian purposes, we will have to look at TP benchmarking.
Yeah. So say if there's an Indian holding company and India is a service provider, then ideally 15% would be the
And the same.
safe harbor is again part of our India TP regulations. And safe harbor usually pegs a very higher percentage where if at all there is any higher markup, 20% or 25% as this says, the officer will not ask any questions and there would not be any litigations per se on this. So that's the safe harbor.
But for all practical purpose, we can resort to a middle ground with documentation
Yeah.
of Indian companies and Indian markup using the Indian GP regulations.
Yes. So for safe harbor, you need to do a special application to the assessing officer before the filing of the Form 3CB and before the filing of the return of income. So that you say that this is my transaction and this is and there's a specific form for that. So you make application within that form, and ideally the assessing officer has to come back to the assessee whether it agrees to the safe harbor that is being applied or it does not agree to the safe harbor. And in all practical aspects, as much as my experiences go, the assessing officer never come back to the assessee. So usually assessee is again thrown back to the usual thing where it has to go ahead and file its 3CB and maintain that with the study documentation, conduct searches and all. So that's the so let's move to the documents that has to be maintained and how the benefit test can be proved with those documents. My favorite one being the agreements again. So we need to mention nature of services, remuneration, about what kind of remuneration would be paid. As I said, cost plus markup is the most eligible or most appropriate method. So that has to be there. The reasons again, the same one, which is the benefit test and the third party, whether third party would be willing to pay for those kind of services or not, and is it a shareholder activity? Any kind of email exchanges, um, virtual or physical meetings again, and any kind of strategic guidance which would be received. Okay, so all these kind of things need to be documented appropriately, need to be maintained in files, and I would recommend because nowadays we don't have the thing of maintaining it in files. So ideally, उसका PDF कर दो of all these cases. For example, because we may have say virtual meetings, we may not have any kind of a document to prove that okay there are minutes to the meetings which are available. But if at all there are no minutes to the meetings available, what will you do? You can always have a screenshot of the calendars and the calendar invites that are there. So, the calendars have to be very much specific. They need to contain agenda as well of what was the agenda or what is going to be discussed. So, all these kind of documents will help to prove that these are services which have been actually received and may help the officer also to understand that yes, services have been received and then no adjustment would be warranted. I'll take up some case laws, and the very prominent one being the case of Lanxess India Private Limited. Uh, I have also attached some snapshots of the paper book which Lanxess submitted to the tribunal, and you would be amused. And this is one of the very prominent cases where management services has been allowed as a transaction, and no disallowances was made. So the fact of the case is such that Lanxess India provided four kinds of services to its holding company and to its other related parties across the world. So first one being intra-group services, which was low value adding services. Second was IT services. Third was centralized services. IEA is again a IT service kind of thing, and Atrion services, those are AWS, Amazon Web Services kind of a thing. So those are also managed from India and through the Indian entity in license. So the service recipient in this case, of course, those are based outside of India. So here they say that when you provide these kind of services, you need to ensure there is appropriate benefit which you are also receiving. Okay. Sorry, it paid. It is the other way around. The holding entity charged out to the Indian entity for intra-group services like say IT support and so on and so forth. So we had to prove in India that actually you received these kind of services in India. We saw in earlier slides how we can prove. So agreements, there can be other documents which are there, and email exchanges, etc., etc., etc. We see the submission here. The Indian SSE, they provided as many as 2,800 pages of proofs that yes, services have been actually received, and the benefits have been also received. Because in case Lanxess India would have gone to say any third party, they would have paid much more higher amount as compared to what they must have paid to the related party. So if we see on the right side, I have given snapshot of the paper which Lanxess submitted to the tribunal as a proof that okay, these are the services which have been actually received, and the proof of service is actually there, and the benefit is also there. So we see first is time cost allocation working, which says there is say ex employee ने X particular और AB कंपनी के ऊपर इतना टाइम डाला, BC कंपनी के ऊपर इतना टाइम डाला, CD कंपनी के ऊपर इतना टाइम डाला, and then there was some kind of an allocation which was there. Then there are also intercompany agreements, AE invoices, the invoices which are being received from the associated enterprise, the third party invoices for similar kind of services, so that we justify that the AE price was a little beneficial. Then there were case studies and benefits, where say for example there was any C-suite kind of a management which was there, and that because of that particular management we got some particular, or Access India got some particular project in India or some kind of a additional work in India. Then that was documented that because of their presence, this particular contract could be won in India, and because of that, the Indian turnover increased and the profitability in India increased. So if we see the case studies, Project Narmada is one of those cases, or the projects where these benefits were received. There were email exchanges which were done, presentations which were done, or which were given as supporting documents, engineering services about what kind of services would be received from the related party and what all adds up to the credentials of the Indian entity or the related basis of the related parties. Then we see the next slide, which is on the right side again, on the lower part of the right side. It says those are relating to intra-group services, which is cost allocation workings, agreements, then accounting services, where we say that okay, if it is accounting services, then there would be certain settlements because there would be receivables, payables, accounting mein to sab aata hai. So there would be follow-ups which would be done by the Indian or the accounts entity or the accounts people for the Indian entity. So those were their email exchanges. Then we were also having treasury and invoices relating to the treasury management. So those were also provided, and human resource support or the group HR related services which were there. And if you see here again, on the IT front as well, they provided invoices of third parties, because usually what happens and what we have seen is that the group company enters into an agreement with say Microsoft that all my group companies or all my subsidiaries will avail services and will avail say Microsoft licenses from you at so and so prices. So all those invoices were attached. Then we also provided infrastructure about what kind of infrastructure is global providing and what kind of benefits is it providing. We can see from here, that the moment that we have documents in place to show that yes, services have been received, the officer, the transfer pricing officer here said that there is no benefits which has been received. The ALP or the arm's length price of this should be zero. The complete disallowance of the expenditure, उसके ऊपर tax कर दो and you are fine. And if this particular disallowance is more than 1 crore, then secondary adjustment triggers in. We have to bring the actual money into India, which is again a different headache and story. So On that front, these documentations do help to justify that yes, the services have been received and should not be profited. Moving on, again, we have one more case of Delhi High Court in the case of Sabic India, where it says, importance was placed on the consistency of the proper documentation and management fee benchmarking. So, say for example, in 1 year, we have these documents or detailed service documents which are present, but in next year it does not have or we don't have it. So again, the next year would be open for an adjustment risk. So just ensure that you kind of have these kind of documents placed and the supportings placed on a year-on-year basis so that your management fees get forfeited. Again, the next one or the next case is on EKL appliances by Delhi High Court again, which is again a landmark case which says that any expenditure which the assessee undertakes, there is no right of the revenue of the department to say that okay, you can do this expense, you cannot do this expense. It's at the business owner's prerogative to see what is economical for it and what should be undertaken as an expense. It may or may not be economical. It may be a little bit on the pricier side, but that all decision makings has to be left with the assessee. The department cannot go into the fact that okay, you took services from this entity, but whereas this entity also provides similar kind of services, why did you not take from them? You know. So whether to take those services, whether to not, if the benefit is received, if the assessee is able to justify that yes, benefit is received, I paid for app services, then the transaction should be allowed. Cushman Wakefield is again similar kind of an decision that the court held that the TPO cannot question the business necessity. The TPO's prerogative or TPO's analysis has to be only to determine the arm's length price. If it is within the arm's length price, then whether the service is important or not important, that is to be left with the business owner. DHL Logistics, as I said, if we don't have any kind of documentation or there are lack of documentations, then this will go ahead and have a exposure that then adjustment would be done. This is what happened also in DHL Logistics, where the documentation was not appropriate, or there was less number of documentation which was there, so they went ahead to disallow the expenses which were made. The next one is R&D and innovation services. Any doubts still here?
Is there a case law that suggests the arm's length price is not in any way?
No, they suggest that. So there were various cases. So NICE said that the arm's length price cannot be nil, and the benefits has been received. Cushman and EKL says that the TPO has to determine the price. As you said, it cannot be nil, but TPO has to determine the price. But the only fact is there should be some benefit which has been received, and that has been provided by DHL. DHL says that you have to show benefits which are received. Innovation and R&D services, of course, all entities which are into manufacturing process or into say any kind of product related service, they would have their own R&D services which will help to keep them up with the market. So the definition says those are services which lead to and which involve creation of intangibles, high value adding activities, and any other innovative functions which can be termed to be as innovations. Chapter 7 of web says action 8 is where specifically the innovation related aspect is covered, which says transfer pricing relating to intangibles which are generally generated or a fallout of the innovation activities. So it does not clearly define what an innovation is, because when we say innovation can be anything. It can be say an efficient distribution model. It can also be say a new product which has been developed. So say for example, if we have Tally, the initial version of the Tally was an innovation. But when we say tally 1.0 or and difference between 1.0 and 2.0, 2.0 would not be an innovation. It can be only an addition to the existing innovation. So that's the whole difference. Okay. And when we have to, or when we talk about innovation, we always have some thoughts of the DEMPI as a short form as it goes. And OECD does mention about what is DEMPI. DEMPI says the development, enhancement, maintenance, protection, and exploitation of the field. Okay, so we have to look as professionals where the innovation was actually developed, who enhanced that particular IP, who maintains those particular IPs, where the protection or the legal protection of those IPs are based, and the exploitation about how and who commercially exploits these IPs. So all of them are interrelated to each other, but the function has to be defined independently, and we have to see which entity performs what kind of a function. Okay. So the examples would be contract R&D function. So say if I want to innovate any product, but I don't have the capabilities. I would ask, say, Saurabh, can you do this favor for me? That this is what is my broad guidelines. Can you innovate any product? So, say Saurabh will manufacture or innovate some product for me and give me. Okay, so this is what it is. But all guidance, all technical inputs would be given by me to Saurabh. So in that sense, it is contract R&D function because Saurabh will not own the actual R&D. Then there is R&D function wherein there would be independent entities who would be undertaking or their roles would be only to undertake the innovation activities. Once the product is innovated, they would sell off the entire innovation to someone else. Then there would be technology development. We see AI, we see the QR code payments. Those are the technologies that are being developed. Then we see design and engineering support. So these can be any kind of designs. So say for example, when we see foldable furniture, so those are also designs, and those are also kind of an innovation. Support in clinical trials. This is a little gray area where we say, because clinical trials, if it can be functioned on a very independent basis as well, because there are certain certifications and certain medical requirements which require an independent agency to have these clinical trials. And it also can be performed in-house by a related party or by a subsidiary of the group. So it can be both ways. And the last one is intellectual property enhancement. I gave an example of Tally 1.0 to Tally 2.0. So that's an enhancement. So we need to see about who and how did this particular enhancement become, and whether there was any feedback which was received, and then so on and so on. So all of those have to be uh, part and parcel of the innovation services.
So when it's also in contract manufacturing and low licensing arrangements.
So no, those are not innovation because contract manufacturing leads to a development of a product on the basis of the guidance which you would have given. This is like an intangible. There's no tangible product or anything. And what would be not an innovation would be low value adding services which are core to the business. So someone who may use these innovations to go out and market and generate revenue. So those can be not innovation activities. Pricing methodologies, again, transactional net margin method because it is a part and parcel of the service, and a markup. OECD does not recommend any kind of markup for this kind of services, but yes, it has to be dependent on the basis of the function at risk and depending on which country the service is being provided upon. So we have to again go back and do a database analysis for those countries. In India, of course, there is a safe harbor which is there for the R&D services as well, wherein India acts as a innovator or as a contract R&D service provider for the holding company or for the related party which is based outside India. The margin which is suggested is 29%. This again includes all costs, direct, indirect, and add a markup of 29% because this leads to a innovation. That is why the highest markup of 29% is recommended here because it leads to creation of an intangible. You can of course go and asset creation and that's the reason. Um, Now, just one food for thought, or I want some deliberations here. When I am an innovator, okay, I develop some kind of a new product. Do you think that, and when we say, that profit split method, or I mean, TNMM method is the best method that goes in and, costly per margin at the and you are happy. Do you think that profit split method can also be used or can also be determined as the most appropriate method for the value or for the services which India entity must have done to the associated enterprise? So, say for example, we take Coke as an example. Say the formulation for Coke was developed in India on the basis of which Coke mints money and generates crores of revenues and billions of revenues. Do you think India should be remunerated on the basis of a profit split method, which says, okay, this was being innovated by you, take this share of profit?
In the long term, I guess profit split makes more sense, but when you don't know if the product will be successful or not, then 29% is better for from the revenue point of view.
Mhm. Right? Anyone? Yeah. So maybe when I say, I think we should look at the function which is being performed, function, asset, and the risk. Everything boils down to the basics. So that's where in transfer pricing also it boils down to basics, which is the function and the risk. If I have to give you an example or classic case of profit split, it can be where the film actors they go and decide to have some kind of revenue sharing model with the film producers. I think that's the best example that we see. फिल्म चल गई मेरे बदौलत चल गई नहीं चली मेरे भी बदौलत नहीं. That's the risk, that the entity would take. If it succeeds, it succeeds. If it does not succeed, it does not succeed. So that's the function asset risk thing that we have to, of course, look into and then see whether profit split method would be, an apt method or not. The documents that we need to maintain and the benefit test which will help us to justify the transaction before the tax offices would be, of course, agreements. Then the reasons about what benefit, whether any third party would pay for it or not, and whether it's a shareholder activity. Now, when I say about shareholder activity, and I see the example of Coke that I gave, whether it was part and parcel or whether it was main element of India entity to manufacture that product for or manufacture the formulation for Coke UL, or whether it was part and parcel. So that's where we need to understand. Then documents relating to say prototype testing because it's an innovation. So and if there would be a product which is getting innovated, there would be prototypes. So whether one needs to or assessee needs to properly document that yes, there were certain prototypes which were developed. What results does those prototypes get from the testing element? What improvisations were made to those products? The test relating to that and the formal product launch. So the entire thing has to be properly documented so as to justify that yes, there were certain innovations which were happening and this was the first one and this is the last one, and this resulted in benefit to the Indian entity because of which say turnover increase or something of that sort. Virtual or physical meetings requirements and feedback meetings. So when we talk about innovations, it's all about where the gap is, okay, and what leads to the innovation. It would be always something which has some discomfort or someone who has a discomfort would lead to generation of any innovation product. Okay. So just like we saw example of Tally was innovated because we found it difficult to maintain books of records through manual entry system or maybe through an Excel system, which is where Tally came into picture or Tally was generated. And then from Tally 1.0 to current version of say ERP 9.2, we say there has been various feedbacks which it must have received from various entities various testing units that it may have, and because of which it has been there in the current shape. So, those kind of documents need to be there in place. And I would recommend that again, PDF of these documents to be maintained, because the timelines, because section or rule 10D always says about the documentation has to be contemporaneous, which means as on the date on which the services were provided. So it is better that we do a PDF of those documents and maintain them, so that it is there with us at all times during the course of assessment. Because the assessment may come up, say, 2 years after the main transaction has been done and after the main compliances have been filed. So you may or may not have those kind of documents present at that point of time. The system may get corrupted. So it's better to have a PDF of those documents, and then the last one is strategic ownership of the IP and its maintenance. Who has the ownership? Who is the legal owner of the IP, and who maintains those IPs? So all these documents need to be present, and it can help to um, delete the adjustment relating to innovation fees which may come up.
It's a very important point, especially for software companies, because all the production kind of happens in India as a back office, and then IP is generally with the owner.
Right, and that's where the agreement plays a very important role as well. Where in agreement we need to mention that any kind of IPs which may be generated would be owned by the service recipient and not by the service provider. So that's the what's an important point there.
So,
Yeah.
so these agreements and MOUs should that be flagged? So it's not a Roman framework.
It depends where the jurisdiction of those agreements are. If the jurisdiction of those agreements, we say that all disputes would be subject to Mumbai jurisdiction. If we say that, then of course the stamp duty rules of Mumbai, Maharashtra would be applicable. If we say that all disputes would be subject to, say, US jurisdiction or say UAE jurisdiction, then there's no need for any stamp paper for that. Certain case laws, Ericsson India Private Limited, which had royalty payments for the technical know-how. The ruling says that they upheld the payments as arm's length payments because they were supported by robust documentation and benchmarking. We have Sony India Private Limited versus CIT, that is Delhi Tribunal decision again, which reinforces the importance of arm's length pricing for R&D related intangibles and services. Because they say that whether using these particular IPs or whether using these particular technical know-how, what benefit or what was an additional sales which the India entity could undertake. So when we say Sony, we all know, so say for example, we say cameras. So we always say Sony ka camera is better than say XYZ ka camera. So that's the Flipkart Internet Private Limited, this was a little offbeat case law where it says that, if it's an innovation, we see Flipkart. Flipkart is what? It's just a marketplace. It does not have any other kind of a IP, but the way in which Flipkart marketplace functions, in the way in which that particular uh, operating system functions, or I would say, the entire process is there. That was an IP which was created or an innovation which was created. On that basis, it says that all the commercial realities of the innovation driven by these e-commerce companies, they are disallowed. So currently, they have been disallowed arbitrarily, but we need to go and make these proper adjustments and make these proper documentations where we say that okay, these processes are also kind of a part and parcel of the main innovation. And the last one is R&D relating to a manufacturing entity, which is Cummins India. Again, Pune Tribunal ka decision, which says that if at all there is any R&D which has been undertaken by the group entity and or any other related party in the group, because Cummins say manufactures engines not only in India but anywhere else. And if at all they have received any kind of manufacturing excellence, or based on which they can manufacture engines in a more efficient manner, and that IP or that knowledge is transferred to India for their manufacturing processes as well, then in that case as well, we need to understand and address the cost sharing arrangements as well, which may lead to in generation of the effective manufacturing processes. So that's about for the innovation services. Any doubts till here? Okay. We move to AMP. A significant portion of AMP has been covered by my friend Saurabh, but I'll just try to cover what benefits and or from an assessment point of view, from the litigation point of view. So from definition, the definition says these are services which are a standalone category and they typically considered as part of the intra-group services and often associated with the marketing and distribution activities. And they generally include advertising, which can be just creating and placing of ads to promote products or services. So when we were coming, so say for example there's a billboard say which says LG fridge or say Samsung phone or iPhone, so there's a billboard which displays the product. That can be an advertising. Then marketing can be say through market research. We may have a team which will go ahead and analyze the market about whether market is more receptive towards certain kind of products or not. So that falls under marketing research. And promotion includes sales incentive. So say for example, if you buy say X product के साथ Y product free आएगा. So that's the kind of promotion activities that is being done. Um, And the last one is these services may be provided by a parent or a regional hub and shared service center to the other group companies. Um, we come to LG, I mean the case law section, and I'll give a little bit of I'll spend some time on understanding what contributes to be an AMP and what does not contribute to be an AMP. There are two classic cases which we'll discuss in 5 minutes from now or in 2 minutes from now. The examples are services are the distribution channels, advertising for brands, stockists for the products. These are all services which needs to be appropriately marked upon because and remunerated to the Indian entity because these are in as good as a service and not as a allied activity. And what does not contribute to be as AMP are advertisement of products. So, say for example, if I am a distributor of say fridge and I do advertisement of say LG fridge and Samsung fridge or etc., and those does not contribute to be an AMP services. And say independent distribution channels. If I am a distributor or I have distribution networks through non-exclusive distributors, then those are not covered as AMP expenses as well. So the pricing methodology, again, OECD says that it's costless by because those are low value adding services. And India says 29%. That's on the safe harbor provisions that India put up. Again, profit split method. That's again a food for thought that we may see again basis of the function, asset, and risk that's provided. Benefit test agreements, which has to clearly justify or clearly make a note of what services would be provided and what services would not be provided. So, in case of AMP expenditures, services relating to say, marketing of brands, then it can be say promotion or running a social media campaign. So, all these kind of activities can contribute to be as an AMP services. Then reasons whether you would pay for any to any third party for similar kind of services to be received. So say nowadays, the social media marketing is very much in trend. So you would obviously would you pay for any social media influencer to promote your brand or not? Advertisement which caters to increase in sales of the Indian entity or the benefits of the related party. So we need to document whether any kind of an advertisement program or any kind of an promotion that India entity is doing, whether it is leading to creation or existing sales बढ़ा रहा है, if it leads to any kind of a brand building for the main entity. Then there is marketing brochures. So if at all the Indian entity receives any kind of marketing brochures, guidance, and trade show participation. So say holding company would be a participating in any kind of global trade shows. in which they would mention something about India, and so on and so forth. So that may not constitute to be as an AMP service because it's part and parcel in the normal course of the business which they do. And the last is strategic understanding and training. So these again do not constitute to be as an AMP expenses. Uh, so these are the two cases where I would spend a little time on and give guidance about, or discuss what constitutes to be as an AMP expense and what does not constitute to be as an AMP expense. On the top, there is Maruti Suzuki ka case law, and both of them are Delhi High Court cases, and those were very prominent cases, and many Indian or Mumbai entities also placed reliance on them, and they were observers to these particular cases in Delhi. So when we say AMP relating to Maruti Suzuki, it is a manufacturing entity in India, whereas LG Electronics was a distribution entity in India. Both of them ran a separate advertisement campaigns in India. When we see Maruti advertisements, in those time it was debated that Maruti advertisements are more concentrated towards say any kind of a car model which is there. So say Maruti Alto का advertisement हो गया और say XYZ model का advertisement हो गया. So they did those marketing campaigns for the products. Whereas LG, when people saw their advertisement campaigns, I'm sure you must also fondly remember the TV advertisements which were run. Last May, there used to be only a thing which says LG Life's Good. They did not provide any kind of a product over there or any kind of a service over there. So they just mentioned LG Life's Good. So here, Delhi High Court said because in Maruti Suzuki they were promoting models which led to increase in the sales of those models, car models. These can be considered to be as AMP, or sorry, these can be considered to be as advertising expenses, not services. Whereas LG, what it did is because it said just LG Life's Good, it not product or it did not market any kind of a product or any kind of a service. The Delhi High Court said this led to creation of a brand in India, which eventually led to increase in the value of LG as a multinational enterprise, saying that okay, I as a brand is present in say XYZ entities or XYZ countries, including India. That increase the brand value of that particular entity or market value of that entity, which is where Delhi High Court said these kind of activities are services in nature, and you need to be properly remunerated to the Indian entity who has provided these services to you. So these are the two distinguishes between Maruti Suzuki case law and the LG Electronics case law. Any doubts here?
So here the Indian entity was asked to collect the fees from the international accountable.
Yes, along with the profit markup, not just the expense part. So all the advertising campaigns that it ran plus certain markup was asked to cover as a part of the service fee. Okay. So the next one or next two cases are pertaining to Sony Ericsson and Whirlpool India. Again, these two cases are relating to application of BLT, which is bright line test, which was covered by my friend Saurabh. So bright line test was earlier not there. So how will you test the AMP expenses? Okay, so you say that okay, services has been provided. Now, how will you justify that services? You can say that BLT or bright line test does is you add up all the advertisement related expenses, advertising, marketing, promotion, you add those expenses together and you see how much profit has been earned by that entity. Okay. So the ratio between that was constituted to be as a bright line test. Okay. So earlier, when the sixth method was not introduced, through Rule 1080, this particular model was not accepted by the tax office because of Canada discussions that my friend touched upon. But now, when we say we have the sixth method, that is the other method in place, we can still place reliance on bright line test as a model. But it's little difficult that the Indian tax officers would, accept these kind of an arguments. They would still go back to the transactional net margin method because they are more inclined towards that based on my practical experience that I have. So it's better to have an analysis and understanding about what and how the transactions are being benchmarked. Likewise, we have again two more cases of Samsung and PepsiCo, where PepsiCo did more, advertisement relating to Pepsi as a brand and not Pepsi as a soft drink. Other issues, before we go into other issues, any doubts on these low hanging fruits? Because these are the major issues where the tax officers usually tend to make the adjustments and try to you know add up the expenses that are paid or incomes. Okay. So next few slides, I'll take them up on. I'll just take them up. So economic adjustments. So of course, not all businesses are run in a very perfect world. There would be certain disruptions which would be there, which can be, say, for example, if you are a manufacturing entity, there may be certain utilization related issues that your manufacturing setup is not utilized to the 100%. So you may undertake some kind of an adjustment to the fixed cost because your manufacturing setup would say require a fixed cost of say 100x based on say 10x ka your this thing. And but if when we see on our manufacturing entity, which in a practicality they may or may not be used on a 100% basis. So here I would like to touch upon, there was a judgment by uh, Pune tribunal in the case of Tasty Bites India, which says that if at all you don't have an app or a ideal utilization percentage, then you may adopt 70% as the ideal utilization percentage and you can make necessary adjustments to that. Now, Companies Act 1956, they earlier warranted utilization percentage to be put up in the audited financials, but going on and later versions of the annual financial statements, they do not warrant the application or the disclosures of utilization percentages. So that's where Pune Tribunal ka case law on Tasty Bites helps to make those adjustments. The next is free of cost goods and services. Yeah.
So the previous slides, that adjustment related to again a service or a product.
It can be for product as well. As I said, manufacturing setup here. So you may or may not utilize 100% of your manufacturing. And in services, it can be where employees are kept on bench, where we see especially in software related entity. Sorry, I forgot one point which says if we refer to Institute's guidance note, para 6.65 in the Institute's guidance note, which was last released in 2022, it has a very detailed and nice explanation which you can refer to about how economic adjustments are and how it can be taken up and the nature of adjustments can be working capital adjustments, capacity, as we discussed, risk related adjustments, and also location savings related adjustments. So you may undertake manufacturing activity in India versus say manufacturing entity or a manufacturing setup in UK. The costs would be different because of the relevant cost index that is there. Those kind of adjustments can be costly. Free of cost goods and services. What has been seen based on my experience or in the transfer pricing is that many of the assessees they miss out on reflecting free of cost goods that they receive from the related party or services which they receive from the related party, and they do not disclose these in the 3CVs. So it would be recommended that you ensure that you maintain or you disclose these kind of a transaction as well. And our guidance note also says that there is requirement of disclosures of these free of cost goods or services in the form 3CG, and it can be disclosed in the relevant clauses. So, say for example, if it is service, you can disclose it in clause 13, whereas if it is any product or goods, then it can be referred to in or disclosed in clause 11. Moving to employee stock options or restricted stock unit. Nowadays, whenever there are any startups, those startups usually don't provide remunerations only in cash. They also provide remunerations in stock options. And these stock options are usually not stock or shares of the Indian entity. They would be shares of, say, main entity, or my associated enterprise. So what happens? Ideal case or ideal situation would be, there would be some stocks which are received, say, free of cost by the Indian employee, or there would be, or it would have been received at a discount. So, say, if a stock is valued at, say, $50, the India employee would be, say, received at, say, $30, and the balance $20 would be recovered from the India employee in case if there is any kind of a execution of the ESOPs. So what happens is, ideally, the recovery mode, which is there, so the India employee would deduct $20 from the salary and then pay it off to the holding entity, saying that, okay, this is the value of consideration that goes in. This transaction usually is a pass-through kind of a transaction, and many of the assessees, they fail to report these transactions because it does not appear in the related party schedule as well of the audited financials. So many of the entities, they miss out on reporting, but because this is a transaction, it affects my income, assets, and liabilities. So it's better to report these transactions as well. The method can be other method because it's on a back-to-back basis. Your related party must have undertaken some kind of valuation based of the basis of which the value of these ESOPs are determined. So those valuation methods can be provided by the related party whenever there is any kind of an assessment which is there in India, and the tax officer may call for it. So so these can be provided at that time. And also, of course, disclosures in the TP study report is also required because the penal prohibitions are not only relevant to the disclosures in Form 3C, but also to the TP study report as well. Exit charges under the business restructuring. Now, this is a very peculiar or a very unique transaction where, say, for example, earlier entity A was undertaking, say, manufacturing function and also service function. But now, as a part of the restructuring process, they hive off the services part and they give the services to be provided from a separate entity which is based, say, out of India. In that sense, what has to be done is, the India entity would lose out on the potential revenues from the service segment as well. So the India entity usually has to be remunerated on a arm's length basis for the business that it is having off or the business that is being lost. So that has to be done through a proper valuation process, and it has to be reported in the Form 3CB and also in the TP study report accordingly.
Sir,
Yeah.
actually, there is a doubt in ESOP.
Mhm.
ESOP has been issued to the employees. And बेसिकली सर डाउट ऐसा है कि समझो 100 रुपीज का ESOP था, उसके हिसाब से जो भी टैक्स आ रहा था, टैक्स हैज बीन पेड बाय इंडियन एंटिटी ऑन बिहाफ ऑफ द फॉरेन एंटिटी एंड सेम इज टू बी रिकवर्ड फ्रॉम इंडियन एंटिटी.
Right.
बट इसमें कहीं भी मेरा इनकम या एक्सपेंस फिट नहीं हुआ है, तो वाइल बेंचमार्किंग अदर मेथड में तो इसको कैसे प्रेजेंट करेंगे? अगर फॉर्म 3C के में मुझे कुछ नहीं मिला है, तो प्रेजेंटेशन कैसे होगा?
So you're talking about the capital gains basically, because on remuneration, तो जो TDS करता है, that would be the prerogative of the employer entity only. So I suppose you're talking about the capital gains part. So in those cases as well, you have to again go back and say that because this is the tax rate or the tax which the Indian employee would have been liable to, if at all they would have, because there would be of course some workings on for the tax as well, right? So that workings can be held as a basis, as a documentation, and other method can be used for benchmarking.
इसमें एडिशन समझो कुछ नाम सेल प्राइस है,
Because tax rate is different, right?
and other way around कि समझो इशू ऑफ इक्विटी शेयर इंस्टेड ऑफ ESOP that शेयर इशू किया है एम्प्लॉय को, तो ये भी
No. So if it is issue of shares, then there would be no reporting because it would be a direct transaction between the related party and the employee. So there is no India ka role or Indian SSE ka role.
बट बेनिफिट तो हम लोग को हो रहा है ना प्लान उसमें
हम्म।
सर्विसेज दिया इंडियन एंटिटी को इंडियन एंटिटी के शेयर्स का वैल्यू नहीं ना सो वो वैल्यू ऑफ शेयर्स हैज बीन गिवन ऑफ द होल्डिंग कंपनी
Right.
so lead to a benefit to the Indian entity.
Ideally, yes, but how will you determine the value?
Typically, for charge out from a foreign entity in their books, whenever the stock option gets exercised, that charge out is very difficult. You have to actually discuss with client and they say no, we don't want to do it. But then the holding company or a vendor has to for charge out move and every company to be fair.
Right.
That's
Exactly. So in that sense, so whenever there is an allocation which happens to the India entity, so that cost has to be added to your employee cost, right? And then as a part of the employee cost, it gets added for the markup as well, right? So
Yeah.
eventually you are recovering it from them.
It's not
Exactly.
question that you have to discuss with them as a consultant, as a auditor, wherever you are able to get that done.
Yes, exactly. Perfect. Okay, great. Now, this is just a off late. I came across one of you, uh, instances where the third party costs, so say whether they should be treated as reimbursements or whether they should be added to the cost base. Okay, so say for example, if it is incurred by the Indian entity on behalf of the foreign entity and it is not used in the provision of service or in the manufacturing of any kind of a product, then those costs would ideally be added or reimbursed on a back-to-back basis and not added to the cost base. But say for example, if any expense that you do is used in the provision of services, then those costs have to be added in the cost base while adding the markup. Now, when I have to give an example, so say for example, I buy Microsoft licenses basis of the you know the- for the computers which are used in my manufacturing process or the services part as well. Now, when I have or use these particular or buy these particular products or Microsoft licenses, these have to be ideally added to the cost base only, and which there would be a markup which would be added, and then a service ka element aa jayega, and it has to be added to the cost base. But say for example, there are certain costs or these Microsoft licenses you procure to be used by your related party in their jurisdiction, in their entity. So these costs would not be added to your cost base. These costs can be, considered to be as reimbursements and a proper documentation, and then you can not charge markup on these costs. Okay, so it's a little, it's a simple one, but you should be understanding about where are these costs being used. Are they being used in India for the provision of services or for manufacturing processes, or they are being, used by your related party? Right. Last two slides, and I know I'm coming between you and the lunch, so I'll not take much time. And just as a summary, uh, we should maintain ICO agreements, invoices, email exchanges, and all the deliverables, which will help to support the fact that benefits have been received, services have been provided, and any guidance has been provided by the group entity. So and reports can be also in draft mode with the review comments that come in from the group, and final ones, the findings, the video recordings if there are any kind of manufacturing processes, so there would be certain video recordings as well, so those can be there. Delivery notes of the goods, bill of lading, etc., etc. So those documents play a very large role in justifying that yes, the services have been received, and the uh, yeah, I think this is just a summary of what we discussed on what shareholder activities are and incidental benefits, duplicative expenses. Any questions till now? Yes, sir.
I have a reverse case, question of a reverse case. So the entity actually is providing the services to the customer for a low value added services like IT support and accounting and all. And again, the normal bank of a very facility charging 60 to 70% of the markup. Can there be a reverse information on that?
It can be because transfer pricing is not just limited to India. So it would be a reverse repercussion not in India books but by the related party in their jurisdiction. And as section 92(3) says, you cannot do a reverse or downward adjustment. So if at all you have been able to charge that percentage, then it is good for the Indian tax officers, and they would not question the additional tax.
Which also passed over by your no questions.
Yeah. Why would they raise any questions? See, at the end of the day, the India tax office,
So there is still a risk of anything from the
till the time that my related entity is paying, I don't think so there is a risk that the India tax office will any which way face. Yeah.
Sir, one of the cases like end company is exactly Novel.com.
Mhm.
They are distributing over the all the associated prices over the world. So whether the first to first transaction for this, there is no markup in the account. So that transaction we have to report in from this series because that's why there is no profit element for this.
But it's an allocation of the cost, right?
So allocation of the
So it has to be reported.
but it's cost to cost.
So it has to be because it affects your expense side. So anything which affects your income, expenses, assets, or liabilities.
But as such, cost to cost transaction is the more
So even if it's an allocation, your expense will get hit.
right.
So if it's a hit on your expense, and alongside that your asset will also be hit because your journal entry will be expense to bank account.
So putting a subscription for people.
Hmm.
Charges run by the rate of it that is 1,000 euros. Same has to be distributed. Then also
Yeah. Even if you will as a part of the documentation, you will also have to maintain the third party invoice that you would have received. So you still have to report it.
method to be used in this case.
Sorry.
Method to be used.
Other method is what I would suggest. Great. Thank you very much, and thank you for being a patient audience. And I take this opportunity to thank WRC Chairman Ketan Bhai and CA Mangesh Bhai as well. Thank you.
Thank you, Virav Dedhia, for a very interactive session and clearing all the doubts. These days, the number of transactions that we have between India entity and the foreign entities are just getting more and more complex. Some may not even appear on the financial statements, and that's where you need a keen eye to look into those transactions to see what will be the impact from the point of view whether we need to charge any extra cost because of that. And so you have done an amazing job in terms of categorizing all those expenses for us and also to see how and what kind of markup we need to charge. So all my doubts have definitely got clarified, and I hope the same has done for you as well. So a huge round of applause. Let's congratulate. And with that, we take a break for lunch for about 30 minutes and come back by 3 o'clock.
And other you know, it's short person or other thing, but it's a good that you have to you know, but they're more happy than to be my mom. So then I'm second or very help, but have you order it for the India? It's not your mom, it's free. And such the product. I get the idea, or it's not huge to be a leader or trader. Or climatic farm, based on the place, the creative and quotation payout, other matter, so that's like, or she become which is what is correct. That's right. Our quotation anyway, so. It's a good family to be quite certainly found out. Right, because that's the market. That's right. Here, but it was fine. It's not really right. Right, this one's That's Mas this also basically the concept of inter-employee testing. In the royalty, the one non-resident
What is this? Set up your camera.
other non-resident is the current. And the utilization is in India. Then the non-resident is earning. It's supposed to. And if both of them are associated enterprise, oh yeah. Yeah, yeah. Then if you look at it, it's going to you don't know. You don't have it. And the loan is very fine. Well, प्राची का इंडिया में अच्छा अच्छा अंधेरी क्या है Anisha because just had baby so she's at home right now. Otherwise, actually, I moved my office to Andheri. So she was also with architecture marketing. I will to start to insert the office में एक और किया है उसने अच्छा चल रहा है क्या नजर भी रखने को नहीं दे now she's on maternity leave. She just delivered a child. Yeah, one after the yeah. So that second last one. Are you free?
Indian subsidiary of a US multinational. Prior to joining industry, Kavita worked in one of the big four for 20 years. In her professional journey, she has provided transfer pricing services to leading Indian and foreign multinationals in energy, resources, and industries and consumer sectors. She has successfully defended several clients in audits conducted by the Indian tax authorities on transfer pricing issues and resolved disputes through the alternate dispute resolution mechanisms, that is, mutual agreement procedures, advanced pricing agreements. She has experience in advising multinational corporations on base erosion and profit shifting compliances, that we call it BEPS, compliances, and formulation of their global transfer pricing policies and its implementation. Kavita has contributed
to publications on transfer pricing law and practice in India to BNI, Tax Sutra, Taxman, and has presented at external forums such as Economic Point, Bombay Chartered Accountant Societies, and EU Chambers of Commerce in India. Kavita is a fellow chartered accountant and a BCom honors graduate. I would like to call CA Ravi to facilitate our speaker for the next session.
Let's welcome her with a huge round of applause. Now the diet is yours.
Thank you. We can start. Yeah. Okay. So, good afternoon. Sorry, I don't think the lunch was. There's no Josh at all.
The lunch was really good. Construction is very difficult after the lunch was.
So let's come on, let's check the Joes once again. Good afternoon, friends. First of all, thank you to WRC, the chairman, and the entire team for this opportunity. Lovely to standing here and sharing. So let me tell you one thing. This won't be one way, okay? So I would want to learn and I want to share, not only share my experience, also learn from each other, yours experience too. So please feel free to jump in wherever you want to and you have any doubts. Let's go out from here as an joint discussion. So with this, first of all, thank you, Virav. Virav is a very close friend of mine, and one of the topics which he, discussed, the low-hanging fruit, the intra-group services, the most disputed one across the globe. So whenever I think about intra-group services, I thought just to start with on a lighter note think intra-group services as a character of the movie Dawn. Amitabh Bachchan and Shah Rukh Khan starred in Dawn. So intra-group services itself is another Dawn, जिसको 11 मुल्क क्या इतनी मुल्क खोज रही है बट स्टिल demonstrating the benefit is मुमकिन ही नहीं नामुमकिन है whether it is for the taxpayer or anybody. So just with this lighter note, let's move to some of the other areas which currently, taking a lot of time of a taxpayer and even from the audit perspective from the officer. So with this, just a quick glimpse of where we are when we are talking today in terms of the journey of transfer pricing in India. So almost 25 years, a lot of changes, lot of evaluation in the law itself. Uh, One way kudos to our government to keep on, aligning it to whatever it can be or to bringing it in more towards the global OECD guidelines or the global practices. Same time, as we all know that transfer pricing is so core to the overall business framework. We are seeing globally the world is literally coming together. So if the globally business models are changing, definitely new transaction, new unique experience or unique ways of transaction will keep on rising and doesn't look like it will be an end whether for an ex-professional taxpayer or an audit firm, whether we will see in a near future when the transfer pricing will be a settled law across the globe. Secondly, the most important, it is definitely one of the top concern of any multinational. Believe me, many multinationals boardroom discussions are around transfer pricing. One of the compliances, because it is almost wherever you are present. It is not just India. It is a pain for almost all countries wherever the multinational is operating. And even the definitions, it's a wide scope of definition in transfer pricing. The simple thing, what is a transaction? The transaction word itself, the definition is so wide, it will bring everything under the earth, it looks like. And similarly, the international transaction with deeming provisions, things are making more and more complicated for the multinational to understand and implement the policy and then to do a compliance. And as it's always say, transfer pricing is not an exact science, but at the same time, new business models, new considerations, which are just not possible to quantify, but are important consideration in determining the outcome principle. So how to do that? So that juggle keeps going on. Most important, moving on from the quantitative selection of transaction of 15 CR to risk-based audit, but whether the really the uh, time of the taxpayer or the officers has reduced? No. In fact, the risk-based audit amplified with the technology, which, I remember when I started my professional journey in transfer pricing, we used to say that, a lot of work, background work is going on where the tax officers, maybe direct tax guys will be sharing data with custom and, GST. I think the time has come. We are seeing the project inside which the department is working, the way they are exchanging information. So just if I am preparing my transfer pricing documentation in isolation without having a consideration of GST law or a custom SVB order, because believe me, my friends, I feel already the transfer pricing officers or our officers are one step ahead to the multinational. So that is, the game changer. And we are seeing they too understand that the resources are limited, whether their time, the time and effort. So we are seeing a shift from just a fight between comparables to, and even from transaction of whether it should be a cost plus or what towards intangibles, and even move from simple TNMM or the method to profit split method. So this is, in just what I feel has been a journey, and everyone needs to, from a transfer pricing law, needs to take into consideration all these changes. And most important, I think, relook at their documentation, which has been, if they have been preparing and no proper updation on it. So with this, let's move to the first issue. While it may sound a little bit of, because the transfer pricing law, while it is very wide when we come in execution, but some of the concepts keep revolving. The key principles or TP sounding principles are similar. So maybe, maybe my friend Saurabh or Virav might have touched upon on the little bit about the comparability analysis, but I'll try to, give you a little facet from how comparability analysis and the audit, transfer pricing assessments are, are neck to neck. So with this, any transfer pricing, whether it is OECD or any tax professional, if you ask, they generally say comparability analysis is like a heart of the transfer pricing analysis. Now, at the same time, I feel if the comparability factors, which are the main key ingredient, which, where what you really do in transfer pricing, you compare the control transaction or a transaction between two associate enterprise with somebody who is in an independent, with a third party. But the comparability, how you do a comparison, it is like anything, A or B. Either I have to bring A to this level or if B is here, I have to bring B to the set. So these are called comparability factors. So I always feel comparatively factors, if are not taken properly taken care, then like how you don't, if you don't take care of your body properly, then you are prone to heart attack. If comparability analysis is in the heart of any analysis, I feel comparability factors are the factors, if not taken care, it can lead to a heart attack in form of organ issues. So let's just see once again, even if my friends have covered, I thought, let's relook at it what it is, because going forward, all our sessions will be revolving around this factor. So, first of all, the most important part in any TP documentation is, let me take a step back. What are the common questions, if any, I'm sure all of you must have had, even if attended one audit or one assessment of transfer pricing, the simple questions which always come out from a transfer pricing officer is why you need to enter this transaction? You know, why is not the third party available in the open market? Simple question, my friend, which is generally a starting point of any standard question that you see. And this is where, the not only our Indian law, but the OECD also, which this says, please first find out what is the financial and commercial relationship between the A's. Break it down, find, try to understand how a particular company is operating in an industry, how the different aims or different parts of the entire supply chain are connected, interdependent. And that's further breaking down, what a particular company is doing, whether it is a production company, it's a distributor, a marketing, or R&D support service provider. Then only, if you are able to understand the role of your Indian taxpayer in the entire supply chain in which the global multinational might be operating, I think some of the answers you can give, that why these transactions you have entered into it, how your multinationals are interdependent in the entire supply chain. So this is the first framework or the first thing which many of us just including me sometimes when we review every yearly the documentation. Okay, we just have a back of our mind, nothing has changed, the nothing business in the transaction, but we overlook because there might be some change in the industry supply chain. And there might be just an formation of a small new company somewhere in other jurisdiction may have an impact on the transaction which you are testing in your documentation. So it's a very important part. Have a look on it. And then once you identify the financial and the commercial reasoning between the A's, and now the second important part when you have to find out the comparables, you need to delineate or dissect the transaction which you want to test, and first try to understand what this transaction is. So that is where the comparability factors comes into place. So what are the major items of a transaction we need to see? The first thing is the contract. The contract is a written intent of the parties what they want to do. Okay, but is the contract enough? No. Definitely, the other when we move forward, we'll see the other factors combined or jointly needs to look into it. Why contract is important? Because it's a starting point, legally enforceable, piece which give rise to any transaction. But on the same time, it has to be seen along with the actual conduct of the parties on the ground. Give you a simple example. Say just all the examples what I'm going to discuss is in a hypothetical. Okay, so just don't try to correlate with any tax rulings or something. Say L'Oreal, they just appointed a branding agent or a brand agent in India just as a distributor. Okay, so let's say a distributor to just purchase and sell their L'Oreal creams in India. And that's exactly written in the contract, the simple purchase and sale agreement, especially the purchase and how the price and everything will be determined. Out of nowhere, recently then we saw that the Indian counterpart actually hired branding agencies And they did a high campaign, a high-end campaign with, say, some celebrity, say Kareena Kapoor. But in the contract, nowhere it is written that is it is the the duty or it's a function which the local party had to perform, whether it was neither the contract said about that, nor did they mention anything about that the parent A or the L'Oreal US will reimburse the local entity for this efforts. That's where, when after 2 or 3 years down the line, when the case picked up with the documentation, you have enough evidence in form of your profit and loss account where huge advertising expenses sitting in your, on your expense side, and maybe overall margins. While, what we say, okay, I am within the range, but are you a range toward the extreme end? If yes, then you need to find out whether the contract really spoke about building the Indian market, building, expending out so much of marketing expenses. So, and generally what happened, when we enter into a contract, it's almost a 5 years, 10 years, we think nothing has happened. It's always, advisable to relook at the contract if something needs to be added up. Because it generally happens, when I may enter into a business and with my business partner, we think that we will do this and this. But when as we progress, we sometimes, become a blind spot. We forget that we are actually doing something more, which needs to be documented. So instead of feeling sorry at a later stage, it's always better to relook at the contract and update it with the actual contract. The second most important part, the function, asset, and risk, everything of transfer pricing revolve around this. The functions, whether you are doing R&D, you're manufacturing goods, you're distributing, what you are doing, it needs to be both about the taxpayer and about the aids has to be clearly spelled out. And not only functions, what are the assets? Is there any significant assets the Indian taxpayer is, employing? If employees are significant for a service industry, then it's better to also check overall how much your employee cost is a major chunk of your expenses or how it is. Then the most important, which we generally say, okay, risk. We don't realize even a single tick in our function. Generally, we do a FAR analysis by just ticking against, right? FAR, FAR. A single risk can lead to a different interpretation by the transfer pricing officer if really the Indian taxpayer is not assuming, or other way, even if it is assuming that risk, but it is not documented. Because generally, in a normal, accounting or economic principle, higher risk, higher return. Okay, so all the risks have to be, whether it's a product risk, infringement risk, market risk, whatever relevant to your transaction, better to relook at it from the contract perspective, from your actual conduct, who is really, bearing that risk. The second, the characteristic along with the comparativity factors, one of its characteristic of property transfer, if it is an, purchase and sale of any goods, or if it is a service transaction, then what is this transaction is of services? Along with economic circumstances of the parties, of the market in which the parties operate. Here it is indirectly speaking about the market situations, because that contract or a particular parties might be behaving in a particular way, maybe that is an market scenario, because some of the products or the business we see, they are cyclical. Okay, so you will see generally up, down. So here again, a multiple year data may help you to see it. Generally, maybe 1 year business थोड़ा नीचे रहता है, or second year it comes up, or in few months it is a business is there or not. So this way, you need to take care of that economic factor. Like in recently, U.S. tariff, many businesses have been impacted. So how a particular taxpayer is responding to tariff, and how the industry is reacting or considering that tariff in their overall expenses side. So maybe may not be currently this is a year of a tariff, but when we do an analysis of next 2 years, 3 years, we may have to look into that. One example always come into my mind that COVID taught us a lot of things. One of the thing, after COVID, many big multinationals who are mainly, they have relooked at their supply chain, especially the product. If they have to distribute the products, they have increased their warehouse, or they have ensured that the warehouse is near to the clientele, or they have asked increase the spare capacity, so that if one of the warehouse of their multinational gets the supply is disrupted, the other warehouse can take care of it. But just see if one of the Indian taxpayer is actually, providing a logistical function to its multinational, if multinational after learning from COVID has asked them to, invest in a spare capacity. You should have an additional capacity more than what you require for India, so that if there's any disruption in, say, Sri Lanka, Bangladesh, the Indian entity should be able to do the logistics. But you will be when you go out and find out the comparables, maybe we will not be able to find a comparable who might be taking the additional function of spare capacity and stepping in case of a disruption by any other aids. So maybe if accurate adjustment can be done, it has to be seen. If not, we have to demonstrate it that these are overall, conditions of a particular market, and to respond to that, this type of arrangements has been done. And in the similar line, the business strategies, business strategies, any strategy has an impact on the multiple impact on many factors of an enterprise. It can be innovation, it can be, introduction of a new product, risk diversification, a particular segment not working, we have started thinking to, stop it and focus on some other segment, diversified business. So we have to consider what the impact of this business strategies on a particular transaction. Like say, if you are entering into a new market where already, the product has a competition. So like just to get the your market share, you may decide to sell it at a lower price, but your transfer pricing audit will come after 3 years, my friend. So you need to start documenting your business strategy. You have to also 3 years down the line somewhere your projections, so that we feel that maybe initial year, first year I will spend it, which the benefit of it I was supposed to get in second year or third year. So, when when the audit comes up, you have to demonstrate it with your projections that this is the where we have done, and maybe a margin adjustment that with or without that marketing expenses, how has been your margins compared to comparables. So this type of documentation, when we do an analysis of the transaction, and especially when we enter it, because one of the biggest challenge, I'm assuming most of us are from the financial and tax, background, or a department if it is from the multinational organization. After 3 years, if you go to a business guy and a marketing guy and ask him, okay, what was your strategy and why we incurred so much of advertisement expenses to, promote our brand or something in India, believe me, the support, I don't think the marketing guy will really remember what strategy they applied. That's so better, we collaborate right now along with our marketing guy or a business development head and try to find out what is the reason of entering into those transactions, if it is not standard or it is little away from the industry practices. Because the other gray area or other area which really the officers would not like to start with is by seeing losses net level for the India level. So, better we understand the reason for the losses, why it's happening. Is it introduction of a new product, or, is it a strategy to enter into a market and everything? Start documenting the reason the projections which the business development guy might have, and then try to have a collaborative or a generally a collaborative effort or a method as a secondary support to your transactions if you because TNMM will definitely fail at the loss. So, with this, I'll not take much time on this slide, which are the nine broad steps on how you do a comparability analysis. Basically, how you find internal, external comparables and trying to see the results. I'll straight away jump into it, because of the comparability analysis, 80% of, if you ask me, we were just talking with some of my friends in industry. 70 to 80% currently the issues revolve around the comparability, which is, either the comparable is not right, the selection whether the manufacturer's comparable has been tried to compare with the service industry. If we are doing some taxpayers doing some comparability adjustment to increase the results or the better acceptance of results that are generally rejected by the lower level authorities. Dispute on choice of method. Earlier, I remember before the other method came, every time the officers used to say, you guys always come up with TNMMO. Is there no other method? But trust me, nowadays I am seeing the officers are rejecting all other method, are only moving to other method. So recently, almost some of the tribunals has actually gone back to the transfer pricing officers and saying that you need to justify for adopting other method before and what's the reason of rejecting the other uh, accepted economic methods. So the PLI and the one piece which we'll cover is the timing issue. When I discuss or enter into a taxpayer, enter into a transaction, it's generally 3 or 4 years gap when the transaction will be tested. So in this 3 or 4 years, generally in India, we one movie एक movie पूरा खत्म हो जाता है. So so the characters change, everything change. So that's the reason that's create a lot of issue. And the most important, which we'll discuss in coming side of the tested part. So with this, on selection of comparable, while it is said that internal comparable will be good, means it's easy or acceptability is higher. But generally, the first step which I talked about, the financial and commercial reason, generally you will not find that similar A's might be doing a similar functions, or even if it is, there will be little bit, local differences. So, and especially it gets more complicated, like an industry like pharma, even a slight difference of the product differentiation may have a huge repercussion on the pricing. So it's not that it, nothing like it, but generally we have seen that internal comparables difficult to do. But at the same time, I also feel with the introduction of BEPS, the C by C, wherever it is applicable, one thing which can be useful, or in fact we should check is if suppose the Indian taxpayer is a local distributor, and if somebody else in other location is also acting as a similarly as a local distributor for that commanding say European market, better to check what is their margin, what they are earning on your, because that will be compared by the officer, because now they have this exchange of information route to check it. So, and if there is a deviation, we better, have that exercise of the reason of deviation. So definitely, then we move to the external comparable. While we have the acceptable database, but still there are a lot of practical challenge or limitation when this databases has. So first of all, really comparable results from the database, you will not be able to identify what has been their business strategies or sometimes even they might be operating into different segment or different product. We generally don't get the segmental information. transaction level detail because margins are fine, but sometimes the transactional level, if you need that transaction level detail so that if any adjustment needs to be done, that is generally not possible with the limitation of this databases. And the most important, most of the companies result because generally Capitaline, Pro is they what they also do, they try to collect from the public domain into the ROC. Most of the public domain are listed companies whose details are in depth available. And most of the listed companies we have seen in experience that they have do have significant related party transaction. So it becomes difficult to accept that comparable for the comparability purposes. So, this definitely a challenge when it comes to external comparables and uh, on the application of comparables or selection. Generally, the law says, not only the law, the OECD guidance when it's 95 for 2022, it always says that the functional comparability should follow the selection of method and the PLI. But we have seen in many cases the comparables chosen by the officer by rejecting the benchmarking study offered are not either functionally comparables. We have seen in like say, for example, Bechtel in case of a Bangalore ITAD. Company was simply providing an engineering computer-aided designing services to its multinational who was mainly the clientele was say in the field of power plant petrochemicals. So the more of the deliverables are more of drawings, designs, data sheets, and other thing. The officer said, "No, you are actually doing a software development." They didn't understood that functionally, actually, I'm just using computer as my asset to doing the services. So it was in a service industry, which the officer was saying you are actually, developing a product. So when you are developing a product, the functions are totally different. Yeah, and the risk is of the product risk. Here is a service risk. So two different employment. If you are doing a product risk, there will be significant maybe plant and machinery investment. But for a service industry, there may not be any plant and machinery. It's mainly the furniture and fixtures. The asset and the functional base are different. One of the case I remember in Logica. Similarly, the company was doing simple marketing support where you're just doing research about the local market and providing that research report to their aides. And in fact, nowhere in the contract it says that uh, their remuneration is dependent on the success of the researcher. When if the really the product is implemented or marketed in that area. But the officer said, no, this is like a commission agent. So completely different function and the risk profile, which is very important. And maybe that's the reason around 80 or 70, 80% of the cases which has been adjusted at the transfer pricing officer has been turned at ITAT level. Because when we go into really the factual aspects of the transaction and the fund analysis. So this is a comparability adjustment if required, whether it's a working cap. Yeah.
Question there. In this case, that you have described, this seems like not so ease of doing business. Is there a repercussion to the assessing officer of kind of wasting everybody's time? Because, like you said, everything gets kind of overviewed when you go to the higher authority.
So in fact, if you remember my first slide, the audit journey so far, and somewhere, two things on this. The way, what I understand, the way our structure has been designed in India. Definitely, we don't have that KPIs where in outside world or in the developed economy, their KPIs are linked to it. How much actually then ultimate that demands turn into it. So here the KPIs are not designed it. So that's the reason, even if it is turned against or if it's the entire, adjustment is nullified, but generally they are not pulled back. At the same time, the department does realizing that they can't keep their hands in all buckets. Okay, and that's the reason we are saying may not be little, but a shift on based on the risk-based technology and using the AI and other form some selection of cases where they also want to optimum utilize their resources on more complex cases and not to run around after this comparables or what should be amount of profit. So comparability adjustment, if there is a material difference between the control and uncontrolled and which can have an impact on your result, and if reliable data is available, then better to do an adjustment, and if not, better to reject that comparable. And you can adjust the tested party also, only the comparables or the both way if it is really increase the efficiency. Some of the rulings, and I have focused on, just I'm not going on to the rulings because there will be a separate session on case laws, but some of the, initial years case laws I have just tried to note down here, which has been a base which really lay down the principles on which the transfer pricing, when it comes to comparability analysis, has to be done. And generally, the recent case laws we see, they follow this judicial pronouncement. And some of the important observations in case of mentographic or e-game, they said the comparable should be selected considering FAR profile. Diagnostic ratios may be applied, which is currently is a limitation of our database. Sale turnover is not the only turnover relevant criteria. Product difference, if it is a huge product difference, and as we discussed in FAR, even a minor difference of the product may have a huge repercussion on the pricing, needs to be considered. Parameters such as nature, line of business, product, market assets employed, size, scope of operation, stage of business or product cycle, performance R&D should also be considered in determining comparability. So basically, the overall, the role, the contribution of your taxpayer and the AEs in the overall value creation of in the supply chain needs to be taken care of. Companies having a significant RPT transaction should not be considered as comparables. Especially we have seen in case of ITITS, most of the cases, the standard list consider Infosys, Wipro. They have significant related party transactions. So, generally it should be avoided beside the last economies of scale which they enjoy. The same thing which we discussed about Infosys, potential comparables show extraordinary volatile results. They should be closely examined before being accepted as comparable. Significant risks such as market risk, contract trade risk, IP risk lead to material difference in values. And the differences are so material, if the reliable adjustment cannot be made, better to reject that comparison. The other, the biggest pain, the contemporaneous data. The law requires us that, and when I'm setting the transaction, I only have the past data. I'm based on, say, projection or the understanding of a particular business at this stage. A particular price is set between A's, like how, and the same thing happens with the independent parties, right? If they selling new transaction, they will generally take the course of the historical data or arrangements and then expected whatever it is. But so the same thing when we do a price setting and when it comes for compliances, in the law, generally the government did try to take care of it because the comparables are not available. The results, latest year data of comparables is not available when we do the transfer pricing compliances. They did try to solve this problem by shifting the transfer pricing compliances from earlier month to November, but still we are seeing 100% the database are not getting updated with the latest data. And then when it comes to at the stage of audit, definitely the officer has the data of the latest year. That is where there might be a cases where your margins, what you tested in your documentation, goes out of the range based on the latest financial data. And this is the first requirement in any assessment, they ask for an updated margin. So what we can do, well, this is now almost multiple year data. The law is very clear now. The law specifically says that the officer will use at time of assessment the latest data. So, as a best practice, what we can do when you are doing analysis and when you see that have a look at your industry first, how the industry is doing. If you feel that industry has, say, for example, has earned super normal profit, but because of whatever the reasons your tested party or the Indian taxpayer may not have, there are chances when the updated margin will be considered, the comparables margins might have been shooted. So better to document it, and also if possible, besides TNMM, look for some other secondary method to support. It may not be full fledged, but if the things come up to showcase that there was a no intention of this thing, these are the factors for which I have earned low margin or I am in the little bit of the extreme margin range. Have a buffer of just depending on how your particular industry niche you're operating. If you feel the margins will go somewhere, say 5-10% up and down, just recalculate the range based on 5-10% and try to see where you are fitting in currently. So if there is too much of risk, better to highlight to your client or to your internal management. So that's the one way we can. Moving on, the other area where a lot of issues of what it is on who should be the tested party. So simple thing, what is tested party? With whose reference we need to test the results. Any transaction generally have two transactions. It can two people or two multinational involved in it, but it can have more than two. But for our discussion purpose, let's say two. So there is no enough guidance in our law what should be done tested party, but generally depending on OECD, UN model, and even the ICAI guidance note, it should be the one which has least complex functional analysis, doesn't involve intangibles, whose data is easily available. And not only the tested party data, but relevant comparables data is available. If any adjustment is required to be done in the calculation or something, reliable data can be taken or may be available. Well, it look very easy, but when it comes into compliance, a couple of things what happen is, first of all, every one of us, only the last 15 days when it comes to the date of compliance, we all are, running around, whether we are, consultant, we are the taxpayer or we are, multinational. So that time, the most immediate for me, the data available is about the just come a compliance currently. So we tend to use that, but actually it is not the right way. And let me tell you, let's take a simple example. Say Mahindra and Mahindra. XUV 700 is my favorite car. Okay, so from Mahindra and Mahindra perspective, just try to see what all functions Mahindra and Mahindra is doing. It is doing the entire R&D or the design drawings of this car, taking the entire manufacturing this starting from planning the production, from fixing the bugs and other things till the time the proper whatever the piece is coming up as per the designs and expectation. Then the marketing efforts, launching the media campaign, and making the customers aware. And we know that Mahindra also have distributors in say in Europe. So here Mahindra and Mahindra has sold their cars to their European subsidiaries for further selling it in a European market. So for this transaction, while if I am doing, Mahindra and Mahindra is my client, my maybe my immediate response is okay. I have an information about the Indian entity. Let me take the tested party and do it. But in the process, just see the functions with Mahindra and Mahindra India is doing. It's so complex. So many intangibles are sitting there, the R&D intangibles, the production, the trademark, everything. But compared to my European entity, maybe okay, the initially the pain is of getting hold of that data, but it is a least complex entity. It's an LRD. It's easy sometimes, to make that party as an tested party, the European entity instead of one. So, because then 3 years down the line, and more specifically, for my environment, definitely the BEPS is applicable. So it become more easy with C by C reporting. You will have an excess, may not be full-fledged profit and loss account, the relevant information which you require for your analysis, how much they are, what's their margins from the selling of this car in the European market. So so the tested party become really important from that. But what has the rationale? Because see, as if we look into a law doesn't specifically say that you can't use foreign party or as a tested party. But initially, we have seen some of the case laws where the foreign party has been rejected, and the rationale given by the officers are generally that you know the regulation require us to consider whether the SSE had earned more or less doing similar transaction with unrelated party and not what the A has earned. And importantly, they have said they don't have an access to the comparables, foreign comparables or foreign. That's the reason they have rejected wherever the taxpayer selected the foreign parties in. But at the same time, there are case laws which are accepted foreign AES tested party, and it says the same principle. If it is a least complex entity, if lot of information is available, if may not be full fledged, have some record, call for the record from an A and have that. And we have seen it. I think nowadays it is accepted if you are able to produce the relevant documents. So considering the positive time, we'll move into the next section of intangibles. So we just discussed now, we are seeing for two reasons, I would say. One, definitely the officers, they have realized comparables markup things have now, they also want to have an optimum utilization of their resources. The second piece, I think the way that India has taken a role in the global economy. 25 years back, and with the push of more FDI, Make in India, other thing, we are seeing more and more critical role of an Indian counterpart in the overall supply chain, which definitely involve, transaction involving intangibles. Because we also, if we have to do Make in India, we need intangibles. We need people to license us the intangibles, or we produce ourselves, or we develop ourselves the intangibles. So this, transaction involving intangible becoming really important and critical in terms of both when it comes how to analyze this, and also how the officers are looking whatever they have come upon till now and from a modeling perspective. So just quickly, what is intangibles? While the our law doesn't have any detailed specific guidelines on intangibles and how to value it. So most of the time the recourse has been taken or has generally taken from OECD guidelines. So the key components of an intangibles, it should be capable of being owned and controlled, should be commercially exploited, use or transfer, compensated as would be between unrelated party, not a tangible asset or a financial assets. The types or the examples are like patent, know-how, goodwill, trademark, contract rights, license. It should not be that just because it is not in books, accounting purpose or tax purpose, something is not intangible. That doesn't mean it's not an intangible for transfer pricing purpose. OECD has specifically excluded the organized or trained workforce, group synergies, and market condition like location saving. But here we see a lot of difference when it comes to our local transfer pricing officer. India feel that the multinationals who are coming to India, they are uh, earning higher profit by leveraging on the cost arbitrage which India provides. So a share of the overall location savings has to be shared with India. But at the same time, one of the judgment of Watson Pharma why Mumbai Tribunal has specifically said if you are testing your result by help of a local comparable companies, then no further attribution towards location saving is required because the margins of comparables are also of India, and the margins is taking care of their location saving too. So these are precisely, some of the examples of the what are trade intangibles, uh, what are marketing intangibles, because even our definition of has been added. What is customer relationship, customer list? All this has been added in the definition of intangibles in our Indian law. So, in say for example, most of us are using Apple iPhone. So, in terms of iPhone, also if you see the Apple logo is a trademark, iOS operating system is their software, design of iPhone is an industrial design rights. iTunes and Apple Music algorithms, they are the commercial secrets and know-how. All are intangibles. So when somebody, Apple US, is just selling one piece of phone, so many intangibles are embedded in that pricing. So with this, as I said, our law didn't provided any enough guidance on any transaction which involved intangible property, how to analyze it, and not only our law, but globally this has been a matter of difference of opinion, and that is where one of the action plan, BEPS Action Plan 8, through which the OECD countries came across and they formed into a DEMP concept. Wherein in any intangible transaction involving intangible you need to look into DEMP, which is D is generally development, who is really developing that particular product design or an intangible, like who is doing an R&D, because it can be a failure too. Enhancement, if a product is developed, it's not like every time we see Apple iPhone coming up with new version within less than a year, twice linearly. So it is an enhancement. They want to make it more efficient or more, attractive to client. What new? So that somebody is in the back of the is working on enhancing that. Secondly, at the same time, maintenance, because once I just made it, it doesn't work like that. If there's something while using, if there's any new bug or problem, it requires a repairing. So this is an integral part of any intangible being developed. Then the most important protection. You need to protect that whatever the intangible by way of patent or your trademark registered and everything. Somebody has to take care of it, otherwise an infringement is the biggest risk. And once an intangibles is developed, somebody is exploiting it to, using it to earn or creating a market share and earn profits for the group. So in an intangible transaction between the A's or in between the parties, you need to delineate and see who is actually doing the development, enhancement, maintenance, protection, and exploitation. Because depending on each contribution, these are like each function and contribution, whoever is doing it, you have to assign their remuneration based on the functions they are doing. Because earlier it was said that I am in the US or the multinational. The parent used to say, I'm funding it. Is the funding enough? No. You have to ensure that all these five stages are taken care by you, or you are the significant contributor. Then only you can say that you are eligible for enjoying the return from the intangibles. Before moving on, I thought this will be the right juncture to think about from intangibles and the journey of intangibles in India. If we see 25 years back when the transfer pricing law came, India has always known as a service industry and the contribution it has done to many multinationals. We have seen many R&D centers, in many big one. There are R&D centers we have seen from almost 20, 21 years has been in India, where they are supposed to be doing, support functions for the global R&D, whether you say IBM or other things, you name, and we have seen it. And I remember when I started my professional journey, that was the second year of the transfer pricing audit, and where India really made a headline in the global newspapers or medias, wherein global trade really got annoyed with Indian officers. They were asking for R&D centers a markup of say 25% or 30% because India strongly felt that this R&D centers are just not cost plus, they are actually developing the entire IPs and they need something more. And when there was news earlier used to float that if this continues, then we will see many multinational closing their shop in India. That was the time, and today when we are talking from the simple R&D to GCC, where more than 50% of global GCCs are in India. So the span where how India is now contributing in the global platform, and they are taking up from the normal coding testing exercise of R&D to a full-fledged. But definitely this 25%, 30% markup, while they did try to bought in the safe harbor, but R&D, how officers look into it, has created a lot of hue and cry, and that is where India did try to bring into a circular 6 to to give more clarity how the officers will look into a different type of R&D centers. What is a cost plus is okay for what type of functions if they are doing, they will be fine with cost plus. How they will treat with a cost sharing arrangement, and where they are undertaking full-fledged R&D, how the officers are going to look into it. And in fact, if I see, maybe till now, well, I can see definitely the shift has moved. Till now, the goal or the focus had been in whenever a transaction of R&D, say India is giving an R&D functions or performing R&D functions for, say, US, the focus is more of who is bearing the contractual risk, what is the India functions, is 20% enough or not, what is the how the it has been calculated. Virav did spoke about like free of cost, whether any free of cost has been provided, whether it has been included in the operating cost or not, and the pass through cost and comparability adjustment. But the shift currently which we are seeing, some of the notable questions, uh, whether A is just a mere cash box, in the sense, is there really only just funding the R&D, but who is taking the the controls, decisions on the risk of the R&D? Who really decide that this is the okay R&D I want to do it, and say at this stage let's stop it because it's not yielding the results we want. Then who is really managing? Just funding is not important. Whether the Indian entity or the US entity who is saying that I am funding, I am have the ownership of the returns, whether they really have that capability to bear that risk of say anything the R&D get failed or it's not, whether they have the capability or not. So that is something, the risk management has to be taken care of it. And the most important, where we are seeing from a cost plus to the journey of profit split method. Many cases the department feel that the profit split method is the right method for the remuneration of intangibles. So that's a broad shift, captive to GCC and cost plus to GCC on the area of intangibles. Uh, Time check. Okay. So with this, I thought let me just this. I'll just move forward. So just a case study wherein of the transaction with intangibles, how the six-step framework, just on a helicopter view, how these transactions are divided into steps and needs to be looked into when you are doing an benchmarking analysis of any transaction involving intangible. So just a simple example, ABC India and ABC Singapore. So the brand name is ABC. They do business of providing cloud support platform to their clients with along with the services. So the cloud platform is actually, has been outsourced of developing that to by Singapore to their ABC India counterpart at a cost plus 12% remuneration. So it is like you can say a captive R&D center, ABC India. And once that platform has been developed, it is then exploited by both Singapore and India into their respective jurisdiction by selling this product to their respective clientele base in Singapore and India. And for this, ABC India again takes back that IP right on a license for exploiting in India market or selling it in India market and pay a license fee of whatever the India sales it generates at a rate of 4%. So, and so first the six-step approach, which so before I move, is the facts clear here, or you want? Because the rest of the slide depend on it whether the facts is clear or not. So two-way transaction. First, the IP is being developed by India as a contract R&D on behalf of Singapore entity. One, the IP is created or that cloud platform is created because Singapore is, as per this fact, Singapore is the owner. It again gives back on license this IP to India so that it can exploit, in the sense they can sell this IP along with services to their clients in India, to third party service providers. So just say AWS cloud computing. So AWS has given to India for first, creating that cloud infrastructure IP, and then once it is created, then this cloud infrastructure is being sold by both AWS US and AWS India to their respective clients. So the first steps, the framework says identify what are the intangibles involved in it. So the two intangibles, broad intangibles involved, one is a trademark, brand name, and the logo of ABC. And secondly, the infrastructure of the cloud infrastructure. The platform, the software product or a platform, including the variants, add-ons, and ancillary tools. The second step is, analyze the contractual. So we are actually, if you remember the earlier slide of the comparability factors, more or less, if you follow the comparability factors, these are also the broad guidelines of delineating any intangible transaction. So what are the agreements here? One is the master agreement between the Singapore and India for the R&D function. It says that ABC India undertakes the development of the cloud security platform, remunerated at 12%. Singapore has a sole right and obligation to supervise, manage, contract, procure, perform, cause to be performed, all work to be performed by ABC India. All AP rights, including patent, trademark, copyright relating to the services, shall at all times be the exclusive property of ABC Singapore. So one thing you noted here, here it is clearly the agreement is saying that the entire functions of supervising, directing, or the of what R&D to be done, how it's to be done. The contract is saying that Singapore is responsible in day-to-day of the DEMP function, the development enhancement maintenance. Once the contract is ready, when the India takes back it on license, Singapore has entered an agreement with India, wherein it provides both the trademark and the software platform. And India shall pay a license fee of 12% on the gross revenue it earned from Indian customers. And ABC Singapore shall always be the legal and the beneficial owner of the cloud security platform. The customer contracts are the standard contracts, whether it is being entered into Singapore by the ABC Singapore or Indian. It says that it provision of services using cloud. The third step is now let's find out on reality what's happening on the ground, who is doing what. So on reality, the development, the DEMP functions with the development, the entire piece is actually here. It can be seen it's ABC India and their team is doing. Nowhere except funding, ABC Singapore is taking care of the decisions, the day-to-day decisions. Even the management of that risk is not being taken care of. Even the enhancement, in the sense, coming up on the updation, the upgradation of the existing software is taken care by the Indian entity. Maintenance, if there is any bug, repairing, any resolve, any error fixing is required, is done by the Indian entity and their engineers. Protection, both India and Singapore in their respective jurisdiction, because they enter into the respective client contract into both the jurisdictions, they are taking care of it through their separate consultant here. Exploitation, again, because both of them are entering into a client contracts, they are injured, both of them are exploiting in their respective jurisdiction. So this is a synopsis of the on the ground reality. So if you see the trade intangible, that is the trademark, logo and other thing, the software product. Here, majorly India is doing the all the DMP functions. Singapore is only doing the protection and exploitation. So DEM along with PE is done by India. Same way, marketing intangible, when it's taking back on license, except protection and exploitation, which is done by both entity, a major chunk of work of DEM is done by India and their employees. So definitely the risk, who is actually bearing the risk? When the contract says that the legal economic ownership of the IP is with Singapore, but when on the ground, if you see, it's actually India who is taking the major development risk, the technology obsolescence, because they are responsible for upgrading it and to make it relevant all the time for their clients. Infringement risk, they both are taking care by their third party by protecting it through a patent and other thing. The product liability, again, if we see the licensing agreement, it clearly says that Singapore will be the legal and economic owner, but because the entire DMP is done by the Indian entity, and even the Indian contracts specifically says any product liability, it is the respective parties who have entered into contract with the client is responsible. So here too, both the parties are eligible for it. Exploitation, both of them are earning by selling it into a respective jurisdiction. And the funding risk. So here is only one thing which we see the Singapore has provided is the funding. The rest, significant function, significant risk of this entire value creation of the software platform of the trademarks are done by India. So this is the summary of that. The contract and the conduct are not in line. The contract says that the Singapore is the owner of everything. It's supposed to take care of everything, but on the ground, we are seeing actually the functions, the risk associated with it are taken care by India. So the fifth step is, relook at the marginal, relook at the remuneration model and fix it so that it align with the value creation. So in the simple year, what it has been done is what India is doing. The orange color is a full, yeah.
If the intangible asset is not created and leading to the product failures, so the cost will be borne by the Singapore entity completely. It's not going.
We'll come to that. The answer is in the last slide. So the India is doing the major function, the full functions of the DMPDEM. Only protection is something which Singapore, along with exploitation, is doing here. So with this, what does it say is how you determine an arm's length price. So depending on the FAR profile, just contract is not the only thing. Conduct has to be seen. The recommendation of the OECD guidelines that here Singapore in the overall R&D, for the stage of R&D, it is only the funding risk. So return on capital employed or return on investment may be considered as an appropriate return. And for the DEMPI, it can be even failure of an R&D should continue to not only get the remuneration, cost plus remuneration, and should be entitled of the surplus profit and loss arising out of exploitation of IP. So in this, maybe if IP is not created, there is no question of surplus profit. You will not be able to sell it to the clients. So there won't be a global profit which needs to be a question. So only India will get the efforts which they are keeping it, doing it, the employee cost and other things for bringing the for doing the R&D.
So basically, my question was just like when the product is failed, so that will be the whole cost for the Singapore entity. So and they are bearing the whole cost. So
But when the product is failed, there is no intangible which has been.
not just like that. If it is created, so the ownership is also with them. So we have heritage is with the Indian entity. So at finally, the loss and the profit both will be borne by the entity. Then ownership will also be fixed.
So you have to demonstrate that the ownership, not only the funding, as I've said in the previous slide, who is deciding, in which stage? If you are deciding as a Singapore entity, okay, this needs to be done. Okay, now let's stop it. Okay, it's not creating the ending anymore. Even the circular 6 clearly depicted that you clear that, not that clearly lay down that the Indian entity is just working under the supervision and control of yours. The email exchange. Okay, now do this. Now stop this. All this has to be, done with it. If not, then you are not. If suppose when it see the problem will be only when it is converted into intangible. Till the time no intangible, no return. Okay. So when it will be converted into a say super product and everyone will try to take a pie of it, that is where you have to have your papers and email exchange and your organization chart, your decision making metrics in place to demonstrate when it was created, who all did these functions. So that's we'll skip this one Kumar case law, but I thought it will be good at this to discuss one of the recent October tribunal in case of a brand which has touched upon all of our life, I think, in this room. That is Netflix. Uh, so Netflix, I thought it will be important to discuss at this juncture because I feel the significance of this ruling specifically from two way. One, it clearly, somewhere it touched upon that the digital business model has to be looked from a different lens than for traditional business model. And the secondly, in this ruling, somewhere the DEMPI, which we discussed, has been touched upon the. So let's see what's this quickly about this what this Netflix case is. So Netflix US, we all know they are provide on subscription the OTT digital streaming entertainment service provider, the US company. The US company actually has the entire content, the curated library where the subscribers can pay for it and can have an access through their either the mobile application or the website. So the OTT platform, the entire OTT platform is being developed and maintained by the Netflix US, and in fact, I think they have employed significant engineers for taking care of it on a day-to-day, their platforms and other thing. Not only they have developed it, but they have also working on the enhancement of it and also to try to find out the mechanism to increase the the streaming experience of the users by way of say 4K streaming architect or a personalized algorithm. We generally whenever we switch on Netflix it start for it that okay this are the recommended based on your past history. So the algorithm very important. This is an important IP which Netflix US is owning. In the process, Netflix US has provided non-US distribution rights to its Netherlands counterpart, wherein they can, use, reproduce, do substantial all bandwidth related functions for providing the services in all media outside US. Netflix India is, in a non-exclusive distributor access to the IPs, access, access to the OTT for the Indian subscribers. So the role of the Indian entity is just to, solicit, enter, lives with the subscribers as to, promote the services enter into the standard term of use agreement whenever we log in or create a Netflix account. That is the standard term of use which we have to sign as a subscriber. Invoice it, collect the amount, and undertake limited compliance and administrative function, the local, local functions like liaising with the regulators or telecom operators. Very limited role. So what the Netflix India did, they benchmarked, and in the process they paid a distribution fee. Netflix India provided the distribution fee to Netflix US and the Netherlands for the access to the OTT platform for the Indian subscriber. They benchmark this transaction using TNMM by using distributor of software or similar product comparables. And they said that their margin is, at arm's length range to pay the distribution fee. So it's at arm's length. When it came for the, audit, some of the observations what the transfer pricing officer made, uh, and what the officer did it recharacterized Netflix India from limited distributor to an entrepreneur level. What did it say is that first it said that Netflix India has actually taken the technology, the content IP from Netflix US. It has employed significant assets in terms of OCA. OCA is an open connection appliances, which is like, when we will discuss a very interesting remark the tribunal made what how the OCS has to be looked into digital business model. So OCS are like an cache devices which for temporary storage of any data. And the TPO said that Netflix India has taken significant risk and and for creating the local market, and they are actually taking up the entrepreneur risk against the limited risk which has been provided in their transfer pricing documentation. And what they did is they selected some of the royalty rates of content and technology, mixed it, and they applied it somewhere around 57% on the sales of the Indian revenue and made the adjustment. The DRP also somewhere, agreed with the transfer pricing approach, and they, this way the adjustment was made. When the case was went to the tribunal started with again. I will try to go into the steps which we discussed the comparability factors. How to go. They started with first analyzing the distribution agreement. The distribution agreement was clearly it was a non-exclusive right which was given to the Indian entity, wherein they were not permitted to copy, reproduce, or even sublicense their rights. Secondly, they made it very clear that the limited role of the Indian entity was just to solicit, market, collect invoices, and undertake local compliances. The role even of the they also analyze the subscription, the term of use agreement. Nowhere in the term of use agreement also, even to subscribers, it was just an non-exclusive, non-transferable access. You have been given to content as a subscriber, and either I have a right or a permission to change the content or even have any exploitation rights. So clearly, they based on the distribution agreement, it's of limited functions, and even the most important, their risk was financially, they were insulated by way of a return, a fixed return on sales. The Indian entity was getting a fixed return on sales along with a total reimbursement of their operating costs. So they were financially also, they were limited risk distributor. Then coming to we discussed about the FAR, how important it is a function asset and risk. The next step uh, which the tribunal went into it is they tried to show that the limited function which they were of any distributor, what generally a distributor purchase, sale, invoice collection, and the local administrative or compliance function. The same thing where was the Indian entity was doing. it didn't employ any significant assets. Even it had a limited employees of 60 employees who were more role was of marketing, reaching out to subscribers or doing a minimum local customer support. And in terms of assets, mainly furniture and fixtures and the OCAs. The tribunal made an important remark. What is, the business of or function of OCA? It was simply, they were for just to ensure that the bandwidth, they didn't had a bandwidth congestion and have a better streaming experience for the Indian subscriber. Whatever the most watched episode or the content, generally OCA, what you do, you temporarily store them, so that whenever they wanted, you are able to retrieve it fast. So nowhere, it is simple like in a physical trading of goods. What the role of warehouse does, the same role was done by OCA. So it is not that something, it's like an IP, which the transfer pricing officer actually said that it is like a backbone of the entire streaming business. And India is playing a significant role for the value creation for the globe by, by owning this OCA, which the tribunal says, these are not the intangible asset. This is just a normal local infrastructure similar to a warehouse for the local distribution of the goods. And they re-emphasize that the entire DEMPI functions of creating the intangible, the content, the technology, the algorithm is with Netflix US. They have the, even the trademark. They are the owner, and also the financially they are capable of doing it. And somewhere the limited risk profile, the remuneration act as an evidence to that they are insulated from any risk. Okay, so there was no question of any IP being licensed to an Indian entity. Furthermore, this is an interesting case where they also touched upon your RTDS principle, and especially the Supreme Court judgment in case of engineering analysis, where it says a payment by a distributor for just use or access to a software without any transfer of copyright is not a royalty. So the same basis, by calling it as a license, first of all, there is no license which has been granted to Indian entity, and even so, that is, the royalty is not chargeable because if it is not, you are not able to sub-license or you are not able to change or make any change in the software, then it's not a royalty. So these are the some of the observation made by the tribunal, and they said that the recharacterization from LRD to entrepreneur is not valid, and they said it's definitely an LRD model. And when it came to the TNMM, they said that first of all, other method used by a TPO without giving a proper reasoning why the other, the already existing economic methods in the systems or in the law from they have been rejected have not been provided. The royalty rates, the royalty agreements which are used by the officer are all outdated, not tenable. No proper benchmarking strategy or metrics have been provided. And coming to selection of software product or a similar product for benchmarking, say unique digital business model, OTT platform type services, the tribunal referred to already some of the jurisprudence in media industry, some of the case laws of Tarden, Sony Pictures, where because we don't have enough comparables from the media industry. So they have also because of the functionality comparability, function comparability and the risk profile, they are the right proxy comparables to media. So they in this way the TNMM was upheld, and the benchmarking analysis of Netflix India was happened and the entire adjustment was deleted. And one important, again, re-emphasized by tribunal was that any genuine contracts should not be rewrote by the officer if there is no colorful and a shame device. So with this, I thought it's important that Netflix, because it's really touched upon the DEMPI and the comparability factors we discussed. So this, just to summarize, Contract is not the only thing. It has to be in alignment with actual conduct. And if not, as I said, once we enter the contract, generally we forget it. Better to, relook at it, keep it updated based on to keep it relevant and in alignment with the conduct. Just because by funding, risk and rewards of the intangibles will not automatically flow. That MP has to be demonstrated. The focus is definitely, as we discussed, the shift is from now normal transaction to complex transaction involving intangibles from the department perspective. Going forward, with India taking as a center stage in the global economy, more and more unique transaction, more and more transaction we will see coming up for transfer pricing analysis, and with tax authorities having a lot of uh, ammunition in form of exchange of information, power of survey with the information sharing even with local GST authorities and custom. Transparency will be the key. It's better that we take care and ensure not only transfer pricing, because transfer pricing definitely will take care of the two different jurisdiction, but also your local regulation, other local GST, custom, your positions there, whether it is in alignment with transfer pricing or not. Because end of the day, just remember, transfer pricing is not a fight between agencies. It's a fight between two governments. They will keep on fighting for their increasing their share. In the last, if really the stakes are high, one should explore advanced pricing arrangement, mutual agreement culture, safe harbor, bring more certainty and peace of mind in life. So with this, I'm just ready. Thank you. So any questions or thank you.
Thank you, CA Kavita. On behalf of WARC and ICAI, I sincerely thank for delivering a wonderful session and sharing a detailed insight on topic of transfer pricing. We truly appreciate, ma'am, your hard work and time and effort you have put in to prepare the session. And we sincerely and deeply thank you once again. Please give a big round of applause to her. Thank you, thank you.
निकल जाएगी तो होएगा नहीं कौन So our fourth speaker for the day has already arrived. I request Ravi to please escort him to the dais. Sonia, please. So without any further wastage of time, we'll start the session. I request everyone to please settle down. I request Ravi to please formally introduce her.
So we formally welcome our next speaker for the upcoming session, CS Sunil Nayak. He is a FCA of the ICAI. He has been qualified in 2011 and he has a vast experience of last 14 years in the transfer pricing area. He has been associated with the Dhruva advisor since 2015, where he served as a principal. And prior to that, he was worked at the Sudit K. Parekh and Company. His area of specialization is in transfer pricing field, which includes developing business pricing models, conducting transfer pricing audits, preparing documentation related to that, country by country reporting, and the list goes on and on. His experience includes in the various sectors such as the IT, pharma, banking and financial services, real estate, shipping industries, and many more. And apart from that, he has also been co-authored for the various articles. Some of them are Action Plan 13, Transfer Pricing Documentation, which is uh, renowned as the CBC Reporting and Guidance, which is published in February 2016 in the Journal of Chamber of Tax Consultant Mumbai. And another article he has written is Diamond Gems and Jewelry Industry in a transfer pricing book published by the Chamber of Tax Consultants. We welcome him, Sunil Nayak, and please give a big round of applause. Before starting the session, I request Shri Ankush Gupta to please give him the momentum.
Thanks, Ravi, for the kind introduction. I'm audible. Good evening, everybody. So, before I make my presentation, I would like to thank the Chairman Ketan Sayyaji and Mangesh Ganekar, the Chairman of International Tax Committee, for giving me an opportunity to speak in this forum. And this is my first presentation at the WIRC and, of course, outside the firm. Yeah. So, the today's topic allotted to me is recent case laws on transfer pricing. I'm little bit nervous because this is my first presentation. So give me a second to settle down. Okay. So I can see some of the tax practitioners here, couple of known faces to me, and I hope you had a wonderful transfer pricing season last month, correct? So while completing the transfer pricing audit and filing of the three CEBs, I presume you would have definitely taken a certain position regarding the certain international transactions, whether that need to be reported or not to be reported, whether a particular transaction can be classified as international transaction or not, or whether reporting is required in the Form TCB or not. Correct. So in this regard, the case laws, while taking such position, we generally rely on the case laws to, take a support whether particular transactions to be reportable or not. Those case laws generally guide us on how we should interpret the provisions and how we should interpret them, how the tribunals generally interpret, how the principles are applied by the tax tribunals, and therefore it is very important to look at the various case laws that have been pronounced recently. Uh, Today, I will take a couple of case laws which are recently passed, say recently in the sense in the last 1 or 2 years. So I am not taking the case law that has been already discussed in the earlier sessions by the earlier speakers. One of them is Netflix. I think has already, aptly covered the Netflix decision in detail. Yeah. So today's focus on certain case laws which are on dealing with interest on CCDs, how the officers approach for determination of the ALP on the interest on CCDs, and how the tax tribunals have dealt with it, and then corporate guarantees. Generally, the corporate guarantees rate is fixed at 0.5% based on the Everest Cantor ruling and the Glenmark ruling. And now, in this recent decision, how that has been deviated by the tribunal based on the market realities. Then, on the recharacterization, the Netflix case, probably I may have to skip that because Kavita ma'am has already covered that. And then few case laws on the TP applicability on certain items that has not been charged to the P&L or that has been rotated, that has been capitalized, and whether SDT should be applicable on that or not. So with this, the first case law I will be speaking on will be the Goldman Sachs India Private Limited. So it's an NBFC. Goldman Sachs is an NBFC which has issued CCDs to its AE, which is based in Mauritius and Singapore. It paid interest of around 133.72 CR. Out of that, the Goldman Sachs has disallowed around 94.39%, 94.39 crores under Section 94B of the Income Tax Act because of the insufficiency of the profit. And the charge to the P&L is only 39.33 crores. And these CCDs were issued earlier years. The interest paid was 133.72 CR. Now, the SSC has benchmarked uh, based on the Bloom, based on the financial information data available in the BSC, NSC, NSDL, and said that in the DP study report, the interest payment at the rate of the interest on CCDs were 9.75% to 30.25%, and based on the study carried out by them, that said interest on CCDs are meeting the arm's length standard. Now, here the TPO at the time of audit rejected the benchmarking undertaken by the Goldman Sachs. They treated CCDs as hybrid instrument comprising debt and equity component. Because Goldman Sachs in its financial statement has classified CCDs, which has been issued to its AEs, certain portion of the CCD component as equity and certain portion as debt based on the accounting standard 32 as required by the for the financial reporting purposes. And therefore, TPO said that in the financial statement, you yourself has recorded CCD, certain portion of the CCD as equity and certain portion as debt, and therefore these are compound hybrid instrument, and therefore why this should not be characterized as equity. Entire CCD should not be characterized as equity, and therefore he determined the ALP of the interest payment as nil. Now here the DRP has said that it has also upheld the action of the TPO and also characterized CCD as the equity. Further, the DRP what has done is that the interest paid on CCD, why this should not be disallowed under Section 36(1)(3) and also under Section 37 of the Act, because there has been no explanation that has been rendered or submitted by the Goldman India to the tax office, and therefore DRP said that alternatively these interest payments should also be disallowed under Section 37(1) of the Act. Now, the arguments of the Goldman India before the tribunal was that the CCDs are until conversion are dead. So CCD after certain point, after certain period, as agreed in the agreement, are to be converted compulsorily converted into equity, and therefore until conversion they remain the characteristics of the debt, and therefore any interest payment on the CCD should be allowed as an expenditure. So, and for this purpose, the Goldman India has relied on host of decisions. The principle arising from those decisions are that once the CCDs are issued, it remains the characteristics of the loan. Until conversion, it retains the characteristics of the debt, and therefore interest payment should be allowed as an expenditure because interest is a revenue expenditure. And then the reporting in the financial statement as per the accounting standard 32, it only for the reporting purposes, and therefore it should not be taken as a basis or determinative for the taxation purposes. The legal character of the instrument remains that of the CCD. It is a debt, it is not an equity. Until the conversion does not happen, the CCD is a debt only, and therefore, whatever the disclosure made in the financial statement, that is only for the financial reporting purposes and not for the taxation purposes. For the benchmarking purposes, they have already applied the comparable uncontrolled price method based on the information available in the BSE, NSE, NSDL data used for the benchmarking. The revenues argument were that as per the RBI policy, uh, it is classified as equity for the ODI purposes, and therefore this should be considered as equity. And SST itself has characterized CCD as part of the CCD as debt and part of the CCD as equity for financial reporting purposes, and therefore the entire CCD should be treated as equity, and therefore the ALP of the interest should not be should be considered nil, because on equity nobody will pay interest, right? The TPO here advocating TPO and DRP, they are advocating on the principle of substance over form, which requires CCD. Which as per them, CCD is a quasi equity, and therefore it should be treated as equity. Is their argument. So for this purpose, they also relied on the Supreme Court decision in the case of IFCI and Sutanu Sinha, which is tendered in the context of IBC, Insolvency and Bankruptcy Act. So in that decision, the CCDs are treated as equity, and therefore relying on the Supreme Court decision in the case of IBC, the department said that the CCD should be equity and therefore the ALP should be nil. And the department also noted that due to mixed nature of the instrument, CCDs are hybrid in nature. The TPA also noted that there are differences in the credit rating and credit profile of the comparable issuances which SSC has considered for reporting in the TP study report. And the tenures are also different, and therefore CUP is not the appropriate method, and therefore they adopted other method to benchmark the transaction. So the ruling by the tribunal was that the taxability of the income must be determined strictly in accordance with the provisions of the law. So the disclosure in the financial statements are only for the accounting purposes, and therefore the legal character of the instrument need to be seen. The legal uh, character of the instrument is a debt. Debenture instrument is a debt, and therefore debenture CCDs are debentures only. And it has also accepted the point of the SSC that CCDs until conversion are dead. It also relied on various decisions quoted by the SSC, and the the Mumbai Tribunal has distinguished the Supreme Court ruling in the case of IFCI and held that it is contextually different because in the IFCI's case, when the NHA has awarded the project to ICRTL Chengapalli Tollways for the construction of the tolls and roads. There, the entire arrangement was initially decided in advance between the lenders and the promoters that whatever the promoter contribution, which may be in the form of equity or any other form, that shall be treated as equity only. And the documents entered between the lenders and the promoters clearly specify that the promoter contribution always be treated as equity. However, that project went into losses, and therefore and therefore one of the group promoter group entity claims that because I have invested in the form of debenture or the CCDs, it should be considered as debt. It should be considered as debt, and therefore, in the liquidation proceeding, I should be given a preference over the equity holder. But there, the Supreme Court did not agree because in the start of the project start itself, the documentation clearly mentions that it has been agreed that the promoter contribution is treated as equity and therefore CCDs should be treated as equity. And one more point was that the date given for the conversion of the CCD into equity that has already been lapsed. The debenture holder did not convert it into equity in time, and therefore now it should be treated as equity. That is in the context of the IBC law. Here, the ITAD noted that the decision rendered in the IBC context or any other law cannot be directly imported into the income tax law. You need to see what is the law or the provisions of the income tax to decide whether the CCD shall be treated as a debt or equity. And it held that CCD until converted, until conversion, it is retain the characteristics of the debt, and therefore they have not accepted the TPO's contention that CCD should be bifurcated into equity portion and the debt portion, and therefore they said that accounting treatment cannot override the tax treatment. And the consequential impact is that the disallowance made under section 36(1)(3) or alternative disallowance or under section 37 is also being deleted because it has been held that interest is a valid expenditure. Interest on CCD is a valid expenditure. Regarding the benchmarking, because the TPO has noted that there are certain differences in the comparable issuances selected in the TPO study report in the tenure or the nature NCDs or the credit profile of the comparable NCDs vis-a-vis the Goldman search, and therefore they said that this needs a fresh determination, and the matter is remanded back to the TPO for uh, fresh consideration. And here that ITED has also directed that at the time of fresh assessment, SSC is free to submit any other information or any other approach it can adopt for the purpose of the benchmarking. Any question on this so far? So the related ruling regarding the benchmarking, there are two rulings I will just explain. One is in the case of Mahindra. Mahindra Homes is into a real estate sector. So here Mahindra has issued the CCDs to AEs, Singapore AE. The interest rate charge were around 17.65%. Again, the benchmarking approach adopted by Mahindra is similar to what Goldman Sachs has done. It obtained the comparable issuances from the BSE, NSE, and NSDL data. The assessment year in this case was AY 1560. Here, what TPO has done is that it rejected the benchmarking approach of the SSE. It said that the SSE has taken NCD as a comparable instrument, whereas the uh, instrument under review is the CCD, and therefore NCD cannot be directly compared with the CCDs. And therefore, it rejected the benchmarking analysis. Thereafter, TPO identified the comparable NCDs in INR from the Bloomberg database, and it identified certain comparables from the Bloomberg database and determined ALP of 8.61%, and the adjustment made was around 28.94 CR. CITPL has deleted the adjustment based on the earlier ruling. In the case of earlier year ruling, in Mahindra's own case for AY 1415, the additions were deleted by the tribunal on the ground that the TPO has applied foreign currency denominated benchmarking, where the CCDs are issued in the INR denominated, and therefore the benchmarking applicable should be INR denominated. Here in AY 1516, the TPO has benchmarked using the INR denominated comparables. So, and comparables. Uh, Now, before the ITAT has noted that, as I mentioned, TPO has CATable direction for AY 1516 is not correct because in the earlier year, the TPO has identified the comparable which are foreign currency denominated, whereas in the particular year under consideration, which is AY 1516, the the TPO himself has identified the comparables which are INR denominated, though they are NCDs. But the industry sector which the comparable NCD instruments are operating are different. So TPO has selected oil and gas and other sector. The comparables are in the oil and gas and other sector, whereas Mahindra Homes is in the realty sector, and therefore these because of the different sector you cannot compare. The ITAD has finally concluded that because there is a difference between NCD and the CCD, because of their CCDs are compulsory convertible into equity at a later point in time. NCDs cannot be NCDs has to be mandatorily redeemed at a particular after an agreed point in time. Then the tenure may be different, credit profile may be different, and the industry is also different. And therefore, the tribunal directed held that NCDs cannot be compared to the CCDs without any adjustment. And therefore, the conclusion of the tribunal was that you can take the NCD as a comparable instrument for the CCD, but after making certain adjustment for the industry difference in the industry sector and the convertibility factor. But it did not guide on how to do the comparability that adjustment. Neither in the law provides the transfer pricing law provides that how to make that adjustment. Now now it is up to the TPO how we will determine that comparability adjustment between NCDs and the CCDs. Now the difference between in the approach of the TPO in Mahindra's case, TPA has himself has identified NCD as a comparable company, whereas in Goldman Sachs case, TPA has rejected the SSC's comparable just because they are NCDs, not the CCDs. There is a inconsistency in the approach of the TPO himself. Both are Mumbai Tribunal decision, and both are though the accounting years are different. Next, related case law on the benchmarking on benchmarking of interest on CCD is Hyderabad Infratech, Hyderabad Special Bench decision. Here, the CCD is issued by the Hyderabad Infratech to Singapore AE. The interest on CCDs are ranging from 9.35% to 13.5%. The interest paid on CCDs were around 19.89 CR. Here, the transfer pricing officer has been the SSC has benchmarked this interest on CD based on the SBI PLR. What is that SBI PLR that has not been mentioned? But the TPU has adopted LIBOR plus 200 basis point as the appropriate PLI and therefore made an adjustment of around 15.28 CR. So here the TPO uh, adopted foreign currency denominated benchmarking as against the INR denominated benchmarking. So generally, you may be aware that CCDs are always issued in INR denominated. CCD cannot be issued in the foreign currency denominated, and therefore here the special bench ruled that because the CCDs are INR denominated, the interest rate applicable on the CCD should be INR denominated. The domestic lending rate should be considered. SBI PLR is generally considered as the proxy for the domestic interest rates, and therefore uh, it rejected TPO's approach of considering LIBOR plus 200 basis point. Here at the before the special bench, the revenue tried to argue that CCD should be characterized as equity because this ground was taken first time before the special bench, not before the lower authorities. However, the special bench did not address it, given that the question before the special bench was not the recharacterization of the CCD into equity, It is only a whether ALP of the interest on CCD should be determined based on the domestic lending rates or the foreign currency lending rate. So while rendering this Hyderabad decision, the special bench also relied on the decision of the Delhi High Court in the case of water naturals, which said that in the case of loans or borrowing, the rate of the currency in which the instrument has been issued is relevant. The currency of the instrument should be relevant, and therefore the benchmarking has to depend on the currency of the instrument. You cannot take any other currency for the purpose of the benchmarking. Next case law is on the corporate guarantee. So here the question is that whether corporate guarantee are treated as international transaction or not. There are various rulings which now clarified that corporate guarantee after the introduction of the amendment in the Finance Act 2012, corporate guarantees are covered treated as international transaction because explanation 1C specifically the capital financing which deals with uh, various types of guarantees, deferred payment, loans, etc. So the issue is if the corporate guarantee is treated as international transaction, what should be the appropriate arm's length rate? Historically, average Cantor decision has been relied by both the SSC and the transfer pricing officers to say that the ALP on the corporate guarantee should be 0.5% on the value of the corporate guarantee given. So in this case, there is a deviation on the determination of the ALP. Here, the SSC Garware Fullflex is manufacturer of rubber and elastic product. It issued guarantees to its AE, which are in US and Singapore based, for the bank facilities availed by them for their business operations. It did not charge any guarantee. During the assessment proceedings, TPO considered the guarantee as an international transaction and benchmarked it considering 1.4% as the AL. To determine 1.4%, the transfer pricing officer issued using his power under Section 133(6) of the Act, issued notices to various banks, Kotak, IDFC, HDFC, ICICI, Citibank, and gathered the information relating to the bank guarantee rates charged by them. Based on the information collected for AY 21-22, he determined the median at the rate of 1.9%. Now, the TPO also noted that in Glenmark's pharmaceutical ruling, Mumbai ITAD held that bank guarantee rates cannot be directly compared to the corporate guarantee rates because bank guarantee rates are always determined based on the discussions and the negotiation between the banks and the customers. Bank guarantee rates charged by the bank depending on various factors, credit profile of the borrowers, tenure, amount involved, risk profiles of the customers, etc. And therefore, the rate to be charged for the corporate guarantee has to be lower than the bank guarantee rate. And therefore, what TPA has done based on the Glenmark Pharma ruling, that he has reduced 0.5% and from the median of 1.9 and therefore determined 1.4% as the ALP for making the adjustment. Here the SEC's argument before the tribunal was that first it is not an international transaction. Second one, it is the corporate guarantee is a shareholder activity and therefore no charge has to be charged on the corporate guarantee. Alternatively, the SSC argued that even if some fee need to be charged, it should be restricted to 0.5% and not 1.4%. Reliance is placed on there was Cantor ruling, Bombay High Court, and Glen Pharma, where ALP rate is determined to 0.53%. Here, the revenue argued that there is a tangible benefit arising to the AE because of the guarantee are given, the benefit could be in the form of saving in the interest, or probably because of the guarantee only the AE will be able to fetch the borrowings, and not otherwise it do not have received any guarantee from the lender, and therefore there is a benefit to the AE because of the guarantee provided by the Indian parent. And revenue themselves have accepted that the starting point for determination of the ALP for the guarantee is bank guarantee rate, and it has to be adjusted for certain differences, and as done in the and with the TPO 0.5% is the correct um, downward adjustment. Revenue also argued that Everest Canto ruling cannot be relied on because the Everest Canto ruling, the Bombay High Court ruling was issued 10 years back. The market realities today are different, and therefore that 0.5% needs to be increased. And therefore, they are trying to justify 1.4% is the appropriate arm's length rate for the guarantee. And for this purpose, they've also relied on why the adjustment of 0.5% is appropriate. For that purpose, they have relied on the Glenmark's ruling. Now, the ruling of the Mumbai High Court, it agreed with the supervising officers that there is a benefit accruing to the associated enterprises because of the guarantee provided by the Indian entity, the overseas AE is able to fetch the loan, trade facilities from the banker, or there is the interest, at least they are interest in the saving. The bank would have given lower interest rate because of the guarantee provided by the Indian entity. The tribunal noted that why the lender will give credit facilities to the AE is that because of the guarantee, the credit profile of the borrower is enhanced, and therefore there is a saving in the interest rate. And tribunal also agreed that the bank rates cannot be directly compared. It has to be there has to be some adjustment made to the parental guarantees, and therefore they agreed with the approach of the TPO that 1.4% is reasonable. Here, the tribunal also noted that the safe harbor rules mentions 1% guarantee fee, the safe harbor margin, for the guarantees provided by the Indian entity or the parent entity to its overseas subsidiaries. Yeah. So they have not drawn. Yeah. And and so SSC's argument was one of the argument was that Everest Canto ruling 0.5% should be the appropriate arm's length for the guarantee fee. So the tribunal declined to accept that plea because of the market scenarios are different today. The Everest Canto ruling was issued long back, and therefore the market scenarios to be considered today, and therefore the approach of the TPO seems reasonable. So in that direction, the tribunal has directed that upheld the adjustment made by the TPO. Now let's look at. So here one of the point was that regarding the guarantee for GST purpose.
Even if you have a specified ownership transactions. During these directors, they give personal guarantee for loans which are given to enterprise which are covered under 115 BAB or sometimes section 80. How do you see this being applicable to these enterprises when we do the TP related assessment?
So I agree that whenever the guarantees are given, even in the context of SBT, it should be the guarantee fee should be charged. Say that the payer of the guarantee, say the ATIA unit or the eligible unit who are claiming 10-year double A deduction, etc. If they avail the guarantee from the group company and that group company does not charge any guarantee, So then indirectly the profits are inflated, right? That eligible unit is earning more than ordinary profit, which otherwise generally fetched in the open market, right? Had the guarantee been taken from the third party, they would have definitely charged, right? Some kind of fee.
So, really is like outside also being given as a even price.
Yes, now that the Mumbai tribunal decision is there, at least for the Mumbai region, we should, adhere to the principles laid down in the Mumbai tribunal, and then 1.4% should be the appropriate AL. Probably other states can differ, stating that it is not a jurisdictional tribunal for me, and therefore I will not accept that Mumbai tribunal decision. But it's difficult for the Maharashtra state, right?
Has Gavare moved high against that?
I guess no, to my knowledge. Yeah. And even to answer that also, even for GST, has issued circular in I think, end of 23 or 24 that whenever the guarantees are issued for GST purposes, 1% should be considered the appropriate fee. So anyway, if you don't charge it here for GST, anyway you will pay, 1%, right? So at least 1% you can consider as the minimum rate that should be charged.
Many times what happens? You show your system profit equal profit. When you see 70% impact of thinking, only 115 TAB is covered.
The directors of which entity?
The
115 BAB entity or ATI unit in that entity or
TAB institute, where is represented there? For the banking which very science. Legal things.
no. So guarantees can be given even though the loans are secured either by a hypothecation of the assets or maybe by of different securities. So guarantees are generally given over and above the security provided by the borrower.
Yes.
So
There is after we were the issue of nature of guarantees is written over here and maybe written over here, but then you know, please, what are this?
So Garware Facts is a corporate guarantee stating that it's a agreement or the letter issued to the banker stating that for the loan facilities taken from the banker, I will if the my subsidiary does not pay either interest or the principal amount, I will guarantee that financial obligations on behalf of the subsidiary will be met by me. So I'm not too sure on the guarantees issued by the directors in the SDT context, whether that shall be treated as guarantees and therefore a transaction, because I don't see, based on the definition of the SDT given under Section 92BA, personal guarantees issued by the directors may be covered.
Yes, I guess what
I think may not be covered, sorry, may not be covered, is my understanding of the reading of the Section 94BA. 94BA. If other participants have different view, please. Anybody have any different view on this?
sir, like we are taking the guarantee from the parent company.
Right.
Now the bill will be the rating expensive rate. Then we are making the payment for 0.4% to the HSBC bank. So the guarantee tax, whatever the fees is. So the PPO can increase from 0.4 to 1.4.
No, no. Here the guarantee is a SBLC is different from the guarantee. The case which I discussed is the corporate guarantee where parent entity issuing the guarantee to the bankers of the who have lent the money to the AE. Here's the SBLC where SBLC for the issue, as a parent Indian entity will approach the bankers that my AE requires certain kind of guarantee. Therefore, you please issue a standby letter of credit. Now, the banker, based on the security which you provide, with the banker, or issue the SBLC to the bankers of the overseas A, correct? And for issuing the SBLC, bankers generally charge 0.5%, sometimes 1% also. And uh, generally, the practice is that because you have incurred the cost of payment to the banker for making the SBLC charges, you generally recover from the AE based on the cost plus. Whatever the bank has charged to you, plus you add some markup for the administrative convenience and the liaising with the banker, etc., and then you recover. It should not be the case that you incur the cost but don't recover. So you So what is your case? Is that the case that your case is not
It's what we want to move on to the meeting.
correct? Correct.
So how does it so we maybe if the mic is so right
That cannot be 1.5% because in your case, as the banker himself has charged 0.4%, right? So that way, anyway, you are recovering. Over and above, over and above, you also charge some kind of markup to cover your security because you're given the security to the banker, right? Basis which the banker would have issued the SBLC. So you charge some kind of markup over and above the of uh, cost which you pay to the banker. So then I don't think the TPA has the case to make out that the guarantee fee which you should recover is 1.4%, especially when the banker has charged me only 0.4%, right? Yeah. So the related ruling on the regarding the benchmarking of the corporate guarantee. Uh, in the case of Shapurji Palanji, the Mumbai Tribunal decision. Here, uh, the case deals with the letter of comfort and the performance guarantee issued by the SSC on behalf of its AE. So, now what is letter of comfort? Uh, Letter of comfort is a simple document issued by the parent entity to the lender, simply stating that giving some kind of assurance, not the guarantee, some level of comfort of the assurance that in case overseas AE does not perform its obligation, I am there to assist you in getting that obligation fulfilled. So the parent entity in this process does not explicitly guarantee that I will make good the loss incurred by you because of my parent entity. Here, the tribunal said that letter of comfort cannot be treated as a equated with the financial guarantee or the corporate guarantee because there is no guarantee explicitly stated in the comfort letter. It is just a kind of assurance that in case the subsidiary does not meet the obligation, I will assist you in ensuring that subsidiary will make good use the losses or the ensure that financial uh, obligations are fulfilled. So it's just a like kind of assurance given, and therefore it cannot be treated as an international transaction. Similarly, in the context of the performance guarantee, here also the uh, SSC has given a performance guarantee to a customer of the customers of the AE. The TPO has what TPO has done is that it determined the ALP, equated the performance guarantee as a corporate guarantee and determined 1.16% based on the notices issued to the various banks and determined 1.16% as the ALP. Now, here also the point is that whether performance guarantee constitute an international transaction or not. So now the the tribunal held that what is performance guarantee? Performance guarantee is a contractual undertaking issued by the parent entity, which acts as a guarantor to the contractor, which is generally a subsidiary. It has been issued to the customers of the AE, stating that if the AE does not perform the contractual obligations, then I will take up that assignment, I will take up that contract and will complete that contract. So it is kind of explicit guarantee in execution of the customer contracts. So there is no benefit as such passing on by the the parent company to the AE. Because if the tomorrow the customer contract is entered by the AE fails to perform that contract, and therefore now the contract is automatically under the performance guarantee obligation assigned to the Indian entity. Indian entity will complete that contract, book the revenues, book the cost, and whatever profit or loss it will booked in the Indian entity. So because of this arrangement, there is no benefit as such passed on to the overseas AE, and therefore the tribunal held that it is not a guarantee. It is not an international transaction. So next related decision was the Laksha Media and Piramal Glass. There's again uh, Bombay High Court decision. So here, what has happened was that IT18, the tribunal has just merely relied on the Everest Canto decision and said that ALP should be 0.5% for the guarantee given by the parent, guarantee given by the parent entity to subsidiary. It did not went into fact finding of the case. So here, the Bombay High Court noted that tribunal mechanically applied Everest Canto decision. Here, in the case of Laksha Media, so the SSC was into not losses. The financial health of the SSC was not as good as that of the parent entity. The SSC claimed that the my credit rating and the my A's credit rating are the same, and therefore there is no point in charging any kind of corporate guarantee, etc. And it is also argued that tribunal just mechanically applied Everest Canto decision. It has not distinguished or the verified my facts vis-a-vis the Everest Canto fact, and therefore Everest Canto decision reliance by the tribunal is incorrect. So the tribunal also here noted that the tribunal, being the last fact finding authority, has did not do its job properly, and it merely relied on the judgment of the Everest High Court ruling, which is issued long back. And tribunal also not discussed which is the method that has been applied in the particular lecture case. That has also not been discussed, and therefore it said that fact finding is very important. Even in the case, it relied on the SAP Supreme Court decision in the case of SAP Labs, where comparables also treated as a question of the law. Comparables, identification of the comparable, the selection of the comparable, whether it is a question of law or question of fact, that has been decided by the Supreme Court, which said that selection of the comparable may be a question of law, and therefore fact finding is very necessary, and it has to be done at the tribunal level. So, relying on this Supreme Court decision, the Bombay High Court remanded the matter back to the tribunal for fresh adjudication. So, similar case with the Piramal Glass Limited as well. So here you can see that different approaches have been followed by the either TPOs or the tribunals. So so this ruling, Garware full-flex ruling, is deviate from the very long reliance based on the Everest Canto ruling. What should be the arm's length price? And generally, if you refer to the OECD guidelines, they just said that the general bank quotes cannot be just accepted as it is for determination of the ALP. What you should do is that you should identify what is the actual interest saving that has been uh, uh, the saving to the group because of the guarantee provided, and you identify that guarantee and then see what is the saving made, and accordingly then determine what should be the appropriate ALP for the guarantee fee. I think we can skip this, that has been already been discussed in Netflix India case. We can just move on to uh, Mitra Vayu Gujarat Private Limited. Here the SSC is engaged in generation of the electricity by setting up a solar based power plant. For this purpose, they have availed project consultancy services from its AE. AE is nothing but parent entity, and it reimbursed 2.83 crore for the towards the consultancy and salary expenses. Now the here the SSC has not charged that to the profit and loss account because the project is still being set up and therefore charged to the WIP which sits in the balance sheet. Now the AE has allocated that. So, there are multiple projects are going on and multiple SPVs are there. The total cost incurred by the AE that has been allocated to the SSC based on the megawatt and SSC, the AE has not charged any markup to the SSC. Here the SSCs, uh, obviously TPO has made an uh, adjustment of 2.83 CR. The SSC contended that uh, this transaction is not an specified domestic transaction because it is a capital in nature because the reimbursement of expenditure is capitalized and therefore is a capital expenditure not covered under section 48(2)(b) or nor under section 80IA 810. And in fact, the SSC has not claimed any deduction for the year under consideration, which is AY 1415. And but it has disclosed this transaction, reimbursement transaction in the 3CB under clause 23. So the TPO's approach is that the reimbursement of transaction, though not charged to the profit and loss account, is uh, covered under clause 4 of section 92BA. It section 92BA, which is nothing but transaction entered by the eligible unit with a with the connected entity or the related party of the SSC. And TPO also said that you yourself has reported this transaction in the 3CB clause 23 of the 3CB, which says that the reporting requirement under clause 23 is that any transaction entered with the connected persons to which section 80 IA 10 is applicable, whether that is resulted in more than ordinary profit or not. And TPO also alleged that because of this reimbursement of expenses, there is no benefit as such accruing to the SSC. The allocation methodology is are not correct, and therefore the ALP of this reimbursement of expenditure is nil, and entire amount of 2.83 crore was determined as nil. CAT appeal noted that there is no the TPO did not find any mistake or error in the TP study maintained by the SSC. The calculations were never questioned, nor the allocation keys, etc. Therefore, the TPO cannot assign nil ALP to the value of the reimbursement transaction. CAT will also noted that there is no charge to the P&L and therefore there is no claim for that expenditure made by the SSC, and therefore it directed the TPO to delete the TP adjustment. Now here the tribunal noted that though the SSC is entitled, it did not claim ATIA and also noted the reimbursement was not charged to the profit and loss account, and therefore it held that it did not qualify the meaning of SDT, uh, and therefore there is no benchmarking as such is required, and therefore it affirmed the decision of the CIT appeal. So, so here the tribunal ruling, emphasized on the impact of the transaction during the current profit and loss account, and that SSC has not actually claimed ATIA deduction, though it is eligible. So, but it did not comment on what if the SSC has actually claimed the deduction under Section 80IA, or because of this transaction, there is a future impact on the P&L of the SSC. So, to that extent, this decision looks incomplete. So, the related decision on these 2 points, one is in the case of Alphanar Energy Private Limited, though it is not in the context of SDT, it is in the context of international transaction. Here, the Alphanar Energy Private Limited, it is engaged in the generation of the supply and supply of electricity by setting up the renewable energy power plant. Here also, it issued CCDs at the rate of 30% coupon rate. Interest on CCD paid was 46.52 CR. There has been a TP adjustment on the pretext that CCDs are equity and therefore ALP of the interest is nil. And one of the factor was that uh, because of the power plants are in the setting up the stage, the interest paid on the CCDs are capitalized and there is no charge to the profit and loss account, and therefore there is no P&L impact on the P&L. Now here the tribunal mentioned that once the capitalized asset is put to use, the tribunal is noting is that once the capital asset is put to use, the capitalization period ends, then there will be a charge to the profit loss account in the subsequent year, either through depreciation or by way of amortization, or if the SSC, the capitalization item is depending on the revenue item, then or through the inventory route, that there is a charge in the P&L account in the subsequent years. And therefore, it said that the impact of the transaction not only need to be seen in the year under consideration, but also in the future years. So from that perspective, it's held that for a SDT transaction, whenever the claim the SS is eligible for deduction under section 80I or 10AA, etc., you need to also see the impact on the future years, and then you have to decide whether ALP determination in the year under consideration is required or not. That is the directions of the tribunal. And the related on this point whether 92BA is applicable or not if the SSC is eligible but did not claim any deduction. This is a case of Sangi Industries Limited, again, the Hyderabad ruling, which held that provisions of Section 92BA are applicable if the SSC is eligible, though it did not claim any expenditure, because the wording used in the Section 92BA are eligible business. Whether it is actually claiming the deduction or not is does not matter. Once it is eligible for claiming any deduction, then specified domestic transactions are applicable. So often we generally take a view that even though there is a transaction which has been entered by 80I or 10AA, because there is a loss, because of the loss, the companies do not claim any deduction, right? So we tend to take a view that because there is no 80A deduction, the SDT provisions are not applicable. So this case law emphasizes that is a recent one issued in 2025 only, that is a wrong interpretation. The correct interpretation is that once the SSC is eligible for claiming any deduction statutorily, then the transaction is applicable for 92BA. Especially this is important. Why? Because there is a loss during the current year, you will not claim any deduction, right? When it goes and come to the next year, when there is a profit, how that profit has to be computed in the subsequent year, you have to compute that profit for the year under consideration and then set off of the brought forward losses of that particular unit in the previous year, and then the remainder of the profit is eligible for ATIA and not the gross profit which are earned by the SSC during that year. And therefore, based on this analogy, the ITAT has held that the Hyderabad tribunal has held that uh, the specified domestic transactions are applicable uh, to a eligible unit, even though it did not claim any deduction for that year under consideration. I think this is a very important ruling because many of the professionals would have taken a stand that because of the loss, there is no deduction claimed in, and therefore SBT provision should not be applicable. So if the officer comes to know of this decision, definitely there will be a penal consequences of not reporting or the non-filing of the 3CD. I think this is it from my side. If any questions on the case law discuss or any other question, please let me know. Yeah, we can. I think if there is no question, I can. Yeah.
I would like to offer my thanks to CS Sunil for covering all the practical scenarios on how to deal with complications in the TP case laws in the audits and how a case law at the TPO level can be completely, have a different ruling when it goes to ITAT. So what we have seen throughout the day is that documentation becomes super important to keep record of all the transactions, have sufficient margins, have the DP studies done right, and and then take the case help of all the case laws to actually understand how we have to deal with how all the disclosures also needs to be needs to go. And with that, I hope you all have gotten better clarity in terms of term pricing provisions and got your doubts clarified. So with that, let's do a huge round of applause. So I think the box is kept outside. We all can put the CP certificate in the box.
power on.